Good morning. As the Secretary of the Energy and Environmental Markets Advisory Committee, it is my pleasure to call this meeting to order. Welcome to the 5th EMAC meeting with Commissioner Burke as the sponsor of the committee and the 3rd EMAC meeting of 2020. In light of the global response to COVID-19, we're holding today's meeting by video conference to protect the safety of agency personnel, the EMAC members, associate members, guest panelists, and the public. To ensure that today's virtual meeting goes as smoothly as possible and the recording of the meeting is complete and accurate, please identify yourself before you begin speaking and signal when you are done speaking so that we can continue with the next question or speaker. Please ensure that your phone and your WebEx video is unmuted before you speak, and mute your phone once you are done speaking. Please also ensure that the speakers on your computer and any other electronic devices are muted. In the case that your WebEx is disconnected, please close your browser and enter WebEx again using the link previously provided to today's meeting participants. If you would like to be recognized during the discussion, for a question or comment, or need technical assistance, please message me within the WebEx chat. I will alert EMAC Chair Tina Wiggins that you would like to speak during the discussions, which follow the panelist remarks and presentations. Before we begin this morning's discussion, I would like to turn it to Commissioner Burke for his opening remarks.
Commissioner Berkovitz, this is Commissioner Quintens. I think you're on mute.
Sorry, I was on mute. Yes, okay, thank you. Good morning, and welcome to the Energy and Environmental Markets Advisory Committee meeting. The CFTC is entering our 8th month working remotely. I am sure many of you are as well. I'm most grateful for the dedication of the CFTC staff and fellow commissioners to our mission under these challenging circumstances. I've also been impressed with and appreciative of the hard work and resourcefulness of the private sector, including many of the participants and organizations represented in today's meeting, for keeping our physical and economic infrastructure operating during the COVID-19 pandemic. Many of the things we take for granted in our country, turning on the lights with the flick of a switch, cooling our homes in the summer and heating them in the winter, not waiting in line at the gas station, would not be possible without your efforts. As regulators, it is vital that despite working remotely, we continue to engage with the public. I'm very pleased that we are able to conduct this meeting by video, the Commission's first video conference with participants outside the agency. If we can't be together in person, this is the best alternative. Thank our Office of Data and Technology for making today's event possible. At this time, I'd like to welcome our returning members and associate members and thank them for their continued contribution to the team. I'd also like to extend a warm welcome to our 6 new associate members. Susan Burgos is Assistant General Counsel with Exelon Corporation. Jessica Bowden is a fixed income and commodities business manager for the hedge fund Millennium Management. Kate Delp is the Executive Director and Business Manager for DC Data Repository. Jeff Hume is the Vice Chairman of Strategic Growth Initiatives for Continental Resources. Sarah Tamalti is the Vice President of U.S. Regulatory Affairs for the BP Energy Company. And Jeff Walker is the Senior Vice President and Chief Risk Officer of ACES. I would also like to extend my sincere thanks to the former associate members whose terms expired this summer: Jim Allison, Tim McCone, Rob Mort, and Mike Prokop. Their support of the EMAC and the insights they shared with the committee were much appreciated. I wish each of them well and look forward to continuing our relationships. We will begin today's meeting with a discussion of ESG initiatives in the energy industry. The term ESG refers to environmental, social, and governance factors used by certain investors to screen potential investments. Although the environmental component has most recently dominated the ESG discussion and will be a part of our conversation today, we will, for the first time at the Commission, focus on the social component of ESG. We will hear from our panelists in the energy and financial sectors about how their organizations are working to enhance diversity, equity, and inclusion. The events of this past summer have drawn attention to the importance of social factors, such as diversity, inclusion, and equity in the workplace, as well as in society at large. Within firms, there is a growing commitment to promoting diversity and incorporating sustainable, inclusive ethos into the fabric of the company. Working alongside colleagues with different backgrounds and life experiences broadens our perspectives, enriches our capacity for understanding, and reflects the ideals upon which our nation is founded. And it can help a business succeed in different ways. Research suggests that a heterogeneous workforce is more innovative and performs better than a homogeneous one. Investors are increasingly taking social factors into account in their decisions about where to allocate their capital. While we'll be hearing today from market participants about their efforts to diversify their workplaces, the public sector has work to do as well. A working paper by Chris Brummer, examining the lack of African Americans in senior leadership positions across U.S. financial regulatory agencies, highlights the need for greater diversity when it comes to shaping financial regulatory policy. I expect that today's presentations on private sector initiatives will help inform as we too work towards a more inclusive and diverse workforce here at the CFTC and throughout the federal government. I look forward to starting this dialogue today with our EMAC members and associate members. I hope that by sharing policies and practices designed to promote equity and inclusion, we can learn from one another and encourage continued focus and progress on these issues. This will strengthen not just our markets, but our society at large. With that, I would like to introduce our presenters for Panel 1, ESG in the Energy and Environmental Markets. We will first hear from Paula Glover, President and CEO of the American Association of Blacks in Energy. Paula will discuss the work that AABE is doing in partnership with companies to increase African American employment, leadership, and business contracting throughout the energy industry. Next, Tim Burke, CEO of Omaha Public Power District, will share with us how OPPD is diversifying its workforce and partnering with community groups to better serve its customers. Ray Dempsey of BP America will then speak about his role as Chief Diversity Officer and BP's efforts to increase transparency, accountability, and the diversity of its talent pools. Noha Sidom, the CEO of TPC Energy, will share her experience as a woman of color trading commodities and raising a fund comprised in large part of investments from women and minorities. We will also hear from Lopa Parikh, Senior Director of Federal Regulatory Affairs at Edison Electric Institute. Lopa will discuss how EEI has worked with its member companies to develop a voluntary ESG template that provides standardized ESG metrics to investors, and with the American Gas Association to create a sustainability reporting program across the natural gas supply chain. Melinda Prudencio, Chief Risk Officer of the Energy Authority, will then talk about the formation of TEA's ESG statement and its deployment of ESG programs. Finally, Bill McCoy, Managing Director of Morgan Stanley, will discuss his firm's involvement in the Global Steering Committee of the Partnership for Carbon Accounting Financials and Morgan Stanley's diversity and inclusion initiatives. I encourage our members and associate members who are not speaking on this panel to contribute to this discussion during the Q&A session. On Panel 2, we look forward to hearing from Derek Salmon of CME, Steve Hamilton of ICE, and Megan Morgan of Eurex. Each panelist will discuss the ESG-related products offered on their exchange and the underlying market conditions that drive demand for these derivative instruments. On our third and final panel of the day, we will switch gears and hear from Sai Srinivasan and J.P. Rothenberg from the CFTC's Risk Surveillance Branch in the Division of Clearing Markets, or DCR. Sai and J.P. will discuss the role of initial margin in CCP management and analyze IM performance in the energy derivative market through the first 3 quarters of 2020. I would like to conclude by thanking the chairman and my fellow commissioners for their support of this committee and for their participation in today's meeting. I know we share a collective commitment to fostering an equitable workplace for all commission employees, and I look forward to working with you on this important issue. Finally, I would like to thank Dina Wiggins for her continued dedicated service as the EMAC chair, Abigail Knopf for all her exceptional work, who always makes it look easy, as EMAC Secretary, and Lucy Hines for her also hard work and valuable contributions in my office for her work in supporting this committee. With that, I'll turn it back to Abigail.
Thank you, Commissioner Berkovitz. I now recognize Chairman Tarbert to give his opening remarks.
Good morning, everyone. It's great to be here, and I look forward to today's discussion on ESG initiatives, including initiatives on diversity and inclusion. I hope to be able to attend much of today's discussion, and I'd also like to welcome the new EMAC members, Susan from Exelon Corporation, Jessica from Millennium Management, Kate from DTCC, Data Repository, and I also want to thank Kate in particular for her work with us on the swap data reporting rules. She was very helpful in providing some insights that were able to bring that process to fruition. I'm also excited that Jeff from Continental Resources is here. I had nominated Continental Resources because I think they're very much emblematic of the kind of companies that have allowed America to become energy independent. Also want to thank Sarah from BP Energy Company. She and her team were really helpful and constructive during our position limits rulemaking. And then finally, I want to thank Jeff and welcome Jeff from ACES. Really thankful to all of the EMAC members, both the new ones as well as the other ones, who bring the perspective of so many different actors in our markets, from products, producers, distributors, end users in the physical markets, to the exchanges and infrastructure providers who ensure that our markets properly function for the benefit of those market participants. And of course, I want to thank Dina Wiggins, chair of the committee, Abigail as being our designated federal officer, and then of course, Commissioner Berkovitz for sponsoring the committee and leading today's discussion. Thank you.
Thank you, Chairman Tarbert. I now recognize Commissioner Quinten to give his opening remarks.
Thank you very much, Abigail. Thank you for your leadership from a staff perspective of EMAC. Thank you, of course, to Commissioner Berkovitz for organizing today's meeting and for his steadfast leadership of this committee. To Dina for her chairwomanship of this committee and for the agenda that we have for us today. I'm very interested to hear the discussion today. I hope to be able to listen to all of it. I'm particularly interested to hear from the panels that we have and the participants what kind of analysis has been done and how they see ESG factors in terms of representing any outsized returns from an investment perspective, or whether or not there is any literature or research that is suggesting that, and if so, what aspects of each, whether it's the environmental piece, whether it's the social piece, or whether it's the governance piece. In addition to that, I think if we're not quite there yet and haven't developed that kind of research, or if the research is showing that there aren't, I think we need to continue having discussions about investment's role in the economy and in our livelihood and providing for our retirement security, and what role certain policy outcomes and value judgments play in that process, and perhaps they can play a very important role on their own, which is what I'm excited to hear about today. I also heard Commissioner Berkovitz mention my good friend Chris Brummer's research, and I had the distinct privilege of being nominated originally in 2016 to the CFTC with Dr. Chris Brummer, and I thought then and still think he would have and would make a very fine addition to this agency at that point or at any point in the future. And I hope that in the future he's still open to that, and that he would still be considered for that, because while I was renominated for this role, that was not the case with Dr. Brummer, and I think his students grateful for that because of the learning opportunities that he's able to provide for them. So let me express my gratitude to Chris for his research, as well as his friendship. And thank you, Commissioner Berkowitz, again for today. I'm looking forward to the discussion.
Thank you, Commissioner Quintens. I now recognize Commissioner Benham to give his opening remarks. Okay, we are going to return to Commissioner Benham. Commissioner Stump, would you like to give your opening remarks now?
Sure. Thank you, Abigail, and thanks to Commissioner Berkowitz for hosting the meeting. I don't have any formal remarks. I'm actually quite interested in getting to the presentations as quickly as possible. I will commend Commissioner Berkowitz in particular for his stamina. It's been a very busy couple of weeks, and all of those at the agency who've worked on the various rulemakings we've been considering over the past few weeks. So with that, I think the Commission has done a fair bit of talking, and the public has heard from us, and so I hope today to be more of a listener. And I'm looking forward to hearing all of the presentations, and I will be here throughout the day. Thank you.
Thank you, Commissioner Stump. Commissioner Benham, would you like to give opening remarks at this time? Okay, we're going to move forward. Thank you, Commissioner Stump and the Chairman, Commissioner Quintens, and Commissioner Berkowitz for giving your opening remarks. I'm going to turn the meeting over to Gina now. Thank you.
Thank you, Abigail. Thank you, Commissioner Berkowitz, Mr. Chairman, and all of the CFTC commissioners. I'm honored to be a member of the EMAC and to continue to serve as chair of the EMAC. This committee serves an important vehicle to discuss matters of concern to hedgers, consumers, exchanges, firms, and end users within our energy and environmental markets, as well as the Commission's regulation of these markets. Today's meeting serves as a timely opportunity to discuss environmental, social, and governance initiatives and ESG derivatives products within our energy and environmental markets. As chair, I look forward to facilitating the discussion of associate members' perspectives to the EMAC and working with the EMAC members to provide the Commission with feedback and recommendations that hopefully can assist the agency in its oversight of our markets. To ensure that today's discussion is consistent with the EMAC charter, which prohibits associate members from providing reports and recommendations directly to the Commission, we will first take questions and comments from the EMAC associate members after the panelists have made their presentations and prepared remarks on each respective panel. We will then turn to the EMAC members for their questions and comments on the panelists' presentations, prepared remarks, and any feedback provided by the associate members. As Abigail mentioned, please use the chat function to alert her if you have a question or a comment, and we will recognize you as a speaker after receiving your notification. Before we begin our first panel, we would like to do a roll call of the members, associate members, and guest panelists so that we have your attendance for the record. Abigail will lead the roll call.
Thank you, Dina. EMAC members, after I say your name and organization, please indicate that you are present. Please make sure your phone is not muted. If we are unable to hear your response, please send me a message via the WebEx chat to confirm that you are present on today's call so that I can correct the record. Tribute Bland, ICE Futures US.
I'm here.
Thank you, Tribute. Rob Kramer, FIA PTG.
Present.
Thank you. Dimitri Carusis, Nodal Exchange LLC.
Here, good morning.
Thank you. William McCoy, Morgan Stanley.
I'm here.
Thank you. Lippa Parikh, Edison Electric Institute. Jackie Roberts, Consumer Advocate Division of West Virginia. Derek Salmon, Cme Group.
I'm here.
Thank you. Tyson Slocum, Public Citizen.
Good morning. I'm here.
Thank you. EMAC Associate Members, after I say your name, please indicate that you are present. Matt Agin, American Gas Association. Susan Burgels, Exelon Corporation.
Good morning, present.
Thank you. Jessica Bowden, Millennium Management.
Present.
Thank you. Paul Cicio, Industrial Energy Consumers of America.
Good morning, Abigail. I'm here.
Thank you. Sean Kota, National Energy and Fuel Institute.
Good morning, present and caffeinated.
Thank you. Daniel Dunleavy, Ingevity Corporation.
Present. Good morning.
Thank you. Kate Delp, GTCC Data Repository.
Good morning. I'm here.
Thank you. Paul Hughes, Southern Company.
Good morning. I'm here, Abigail.
Thank you. Jeff Hume, Continental Resources.
Good morning, Abigail. I'm here.
Thank you. Kaiser Malik, Calpine Corporation.
Present.
Thank you. Dr. John Parsons, Special Government Employee.
Good morning, present.
Thank you. Julia Patterson, American Public Power Association. Matt Picardi, Commercial Energy Working Group.
Good morning, I am
Sarah,
present.
Thank you, Matt. Sarah Malti, BP Energy Company.
Good morning, Abigail, present.
Thank you. Melinda Prudencio, the Energy Authority.
Good morning, present.
Thank you. Dr. Richard Sandor, Environmental Financial Products. Noha Sidham, Energy Trading Institute.
Good morning, Abigail. I'm here.
Thank you. Jeff Walker, ACES.
Good morning, Abigail. I'm here.
Thank you. We have several guest panelists today. After I call your name, please indicate that you are present. Timothy Burke, Omaha Public Power District.
Tim Burke is here.
Thank you. Ray Dempsey, BP America.
I am present.
Thank you. Paula Glover, American Association of Blacks in Energy.
Present.
Thank you. Stephen Hamilton, ICE Teachers US.
I'm here, Abigail.
Thank you. And Megan Morgan, Eurex Exchange.
Hi, Abigail. I'm here.
Thank you. I will now turn the meeting over to Dina.
Thank you, Abigail. Our first panel today will discuss environmental, social, and governance initiatives within the energy and environmental markets with a focus on promoting diversity, equity, and inclusion. We will hear remarks from Paula Glover, President and CEO, American Association of Blacks in Energy, Timothy Burke, President and CEO, Omaha Public Power District, Ray Dempsey, Chief Diversity Officer, BP America, Noha Sidham, Chief Executive Officer, TPC Energy, Lopa Parikh, Senior Director, Federal Regulatory Affairs at the Edison Electric Institute, Melinda Prudencio, Vice President of Risk Control and Chief Risk Officer of the Energy Authority, and Bill McCoy, Managing Director and Counsel with Morgan Stanley. Paula, would you please begin?
Thank you and good morning. I appreciate I'm trying to get my technology straight here. My name is Paula Glover. I'm the President and CEO of the American Association of Blacks in Energy. I want to say first thank you to Commissioner Berkowitz and all of the commissioners and staff at the EMAC on the EMAC committee for allowing me a few moments to share with you some of my thoughts about ESG and that's in its intersection with DEI. I want to tell you a little bit about the association. The association has had a 43-year history. We were founded with the mission to ensure that the voices of African Americans and other minorities were participating in the formulation of energy and environmental policy. And an extension of that work is increasing the representation of underrepresented communities in this business. My membership spans the entire energy sector, from oil and natural gas to your traditional utility companies, IOUs, as well as renewables. We have a group of entrepreneurs, academics, and the like. I'll start by saying that for the organizations that I work with, there still isn't really broad agreed upon measurement of what S in ESG is. And so many of my organizations struggle a little bit with how should they be measuring their efforts around DEI and demonstrating that to the investment community. Many of our companies have been on this journey of diversity, equity, inclusion for some time, and that commitment has only strengthened over time as folks have begun to see more and more data that demonstrates that businesses that are diverse are far more successful, profitable, and innovative. We understand that having a diverse workforce, as well as doing business with diverse suppliers, does affect the bottom line in a very positive way. However, with the events of this summer, we are seeing more companies actually leaning in, getting more aggressive in some ways around the E, equity, in this space. And as an association, we ourselves have been thinking very thoughtfully and hard about diversity, equity, inclusion, ways that we can support our members, the organizations that support us, and also other things, learning from other industries and others on key things that can be done to make sure that our workplaces are more equitable for those who already work there, as well as those that we are trying to attract. The first question that we always challenge organizations, and certainly that I challenge organizations to ask themselves and then to answer is, quite frankly, what is baseline? What are you doing currently, and how is it going? And so when I talk about baseline, I'm not just talking about broad diversity numbers, whether that's diverse spend or employees, but it's understanding and unpacking those numbers in a way that can be meaningful. So, for example, if we're talking about supplier diversity and an organization has a 30% diverse spend, what we're asking them to look at is, okay, well, in that 30%, what is the representation of African American businesses? What's the representation of women-owned businesses, and so on and so forth? And we think that's really important because as you start to move through this journey of equity, you need to know where you're starting, you need to know where you have gaps, and then you can begin to do the work that helps you address those gaps if you see them, so that the organization will end where they want to end. And so that first question is, what is your baseline? What is the data telling you? Probably taking a little bit of data, doing some measurement, and then beginning to plan around that. It's important as leaders that we understand what's happening in our organizations, and then really taking a look at data to see if it reflects what we want, what we believe should be there, and then work to how we get it. Then the second question is, do our organizations have the right policies and processes in place to be able to have action to move forward? We as an association over the summer decided that we, as I said before, some thoughtfulness around what equity would look like, particularly for those organizations that were asking us questions about racial equity. What could they do? What would be the right action plans? And so we came up with our 5 key action items to achieve equity in our organizations. And while the response of this plan was really developed as a result of the killing of George Floyd, I think the 5 steps are valuable no matter where you sit in this DEI journey. And the first step really is asking organizations to work to create an inclusive environment where all employees feel valued. Many of our organizations for many years have diversity programs. We've had initiatives to encourage young people to study STEM so that they want to get into the energy business. But I think it's time, this is the perfect time for us all collectively to take a step back and see what's happening in our organizations now. The most important part about diversity and inclusion, in my perspective, is the inclusion part. Once we get inclusion right, diversity is a lot easier to follow. And what that means is when we say we have an organization where we want people to bring their whole selves to work, we need to understand what that means. How does it play itself out? What does that mean for your organization? That means that companies may have to do some culture surveys. It means that our leaders are going to have to do a lot of listening, and that may mean that employees will provide their own perspective, whether it's anonymously or not, about how that work environment, that current workplace is for them. Do they see opportunities for themselves? Is there unconscious bias baked into our systems that we're not aware of? All of that work is really the precursor to really doing diversity well and having, I believe, some long-term meaningful impact. The second thing, though, is having a focused effort to increase representation, and in this particular case, increase African-American employment within our organization. And what we're talking about is not just bringing new people in, but we're also talking about developing a pathway and creating an environment to thrive for those who already work for you. So just hearkening back to my previous point, this is, again, another extension of inclusion. Making sure that those who work for you, that your diverse employees who work for you have a pathway to leadership, understand what that pathway is, have an opportunity, is far more critical in my mind than just working to bring in new employees. And I say that because if you do just the diversity part in terms of recruitment and don't focus on the inclusion piece, what you find is that you have what I would describe as a hamster wheel. People who come in and they cycle out, and new people come in and they cycle out. And without a focused effort on, one, understanding what's already going on in our organizations, and then fixing whatever we think is wrong, if there is something wrong, again, the diversity piece doesn't happen. And so we work to create an inclusive environment. We have focused efforts to increase African American and diverse employment. We develop a pathway to leadership for those employees and your existing employees. And when we talk about leadership, it's not just the managerial ranks, it's not just your senior and executive ranks, it's also thinking about who your board members are so that people see themselves reflected throughout that organization, and in that then not only recommend your organizations to others, but they're able to work, they're able to thrive, and the overall organization then sees the benefits of that work. The fourth step is to commit to an equitable spend with your African American owned businesses, as well as invest in capacity building for those businesses who have a focus on your industry. And both of those items are very important. First, understanding what you're spending with diverse businesses now. In our industry, depending on the company, there are lots of layers, there are lots of definitions of diversity. It spans from race, ethnicity, whether or not you're a veteran, gender, sexuality. And what we know is that people fall into lots of different categories all at the same time. And so our organizations need to understand, as I started with, what their data tells them, what's baked into that data, and then you start to begin to fill those gaps. And as we talk about race equity, that means that you want to maybe increase your spend with African American owned businesses, and at the same time understanding that those gaps exist because many small businesses have never engaged with our industry before. And so they are going to need support to build their capacity so that they can engage with us. We're not suggesting that companies themselves do this work. Companies can do this work in lots of ways. They can invest in organizations to do this work already. Organizations like the National Supplier Development, Minority Development Council, organizations like AID, but supporting organizations who can support those kinds of initiatives and those goals for companies are another way to really increase equity and diversity, and at the end of the day, get companies what they're looking for, which is a diverse workforce as well as a diverse supplier base. And the last step is that we believe companies should direct its resources to encourage students to be in this industry and support those students. Many of our organizations support a whole host of STEM programs for students as young as in elementary school, middle school, high school, trying to get students to look at energy as a career path, trying to get them to focus on STEM and STEM aptitude so that they can be successful. But I think there's more that needs to happen. The association, my association, we give out about $250,000 every year to African American students who want to pursue energy as a career. Those same students, though, many times don't have the same opportunities for internship programs, don't have the same opportunities for co-op programs. Many of them, if they're first-generation students, actually don't even have the kind of networks that maybe some of us on this call have, so that they know how to look for a job and start their careers and get themselves get themselves out there. And so we're asking companies to look at our students far more broadly than just supporting scholarship. The scholarship dollars are absolutely important. We know that many students don't finish their education because they cannot afford it. But we also know that those students need the same early career development opportunities as others. And so those companies that have these diversity goals, that are having plans of, for example, making sure that they have a diverse slate of candidates for any hire, should also be asking the same for those students, as they recruit students for their internship programs. And they can do that in partnership with the organizations and the schools that they recruit from. They can broaden the schools that they recruit from. But we're asking companies to really look at the way that they support students, maybe even be a little bit creative and do a little bit more so that, again, ultimately our diversity goals can be met. We understand that the journey for DEI is a long one, and all of our organizations are going to start in a different place. However, we also believe that where you start is not nearly as important as where you end. And with those type of strong outcomes where you end, it's going to demonstrate a benefit for all of us. I thank you for your time, and I look forward to the discussion.
Thank you, Paula. Tim, over to you.
Yes, thank you very much, and thank you very much for the opportunity to participate today, Chairman Berkovitz, Commissioner Berkovitz and Chairman Tarbin, the other members of the Commission. I want to thank you very much for allowing me to be here today to talk a little bit about the activity that's going on with our work around diversity and inclusion. And I lost a little bit of, I think anyway, did I lose the WebEx? Can you hear me? Okay.
We can hear you.
Very good. Very good. Thank you very much. I appreciate that. We'll go ahead and see if I can move forward with this presentation, and if not, I'll just stop sharing and we'll go from there. If you can go to the next slide, please, I believe. Thank you. I'm going to talk about really 4 items. It's really around not just the work we're doing inside our company, but really how we're focused around the community. And I get the opportunity to represent Public Power today. I serve on the Executive Committee of the American Public Power Association, as well as the board of the Large Public Power Council. But utilities are very integrated in the communities in which they live, work, and play. And obviously, as Commissioner Berkovitz talked about, we provide a pretty critical resource of what's going on in our community, not just on the energy side, but really on the leadership side on these critical initiatives across the organization. So I'm going to speak to these 4 areas very quickly. If you could go to the next slide, please. Thank you. Today's a big day for OPPD. We are in the midst, I'm going to be leaving this meeting when we're done with this session to go right into kicking off our day 2 of our 2nd annual CODE conference, our Community Opportunity for Diversity and Equity Conference. Last year we had over 400 attendees. This year it's all virtual. We had over 1,700 virtual attendees yesterday. Very, very important initiative that we have going on. In 2019, we developed our CODE task force, which is really around diversity, equity, inclusion. And we began earlier this year in the first quarter, CEOs around this community getting around talking about diversity, equity, inclusion, and what organizations are doing, where the community is on this topic and action and initiatives. In March, we had over 65 CEOs in attendance. In June, after the death of George Floyd, we had over 140 CEOs, managing partners engaged in this conversation. Today, this morning, we will have a number of CEOs engaged, more than 160 engaged in this topic around diversity and inclusion. So it's a community that's really getting around this topic, which is important, I think, for our city and our region. After the death of George Floyd, the business community got together and said, listen, we need to make statements, very clear statements about our commitment to diversity, equity, inclusion. And so we began to develop what we call our We Will statements. We had 280 CEOs sign this statement, and we will educate ourselves and disseminate the history of systematic racism in Omaha, and the barriers it continues to present today, we will create opportunities to listen to those affected and marginalized by these barriers. We will support, lift up, collaborate with, and fund nonprofit agencies who work tirelessly in marginalized communities. We will use our influence and position to amplify unheard voices. We will improve the employment, training, advancement, support, and success of people of color in our workforces. We will continue the conversation by engaging in ongoing CEO for Code meetings to also begin to think about how our organizations, as Paula Glover so eloquently spoke to, how we engage with our minority businesses within our community. One of the things that we did in 2019, most chambers have leadership academies, executive leadership academies for mid-level folks within organizations in the community. Last year, the Omaha community began a Lead Diversity Academy, bringing in mid-level managers really focused on lead diversity activities. We had 25 critical leaders in this community focus a full year on diversity, inclusion, equity items. We have 50 in our next academy coming up in 2020, 2021. And this work is really part of our 2040 priority, a plan that started in 2017 that we funded with about $30 million of community capital investment to really support these initiatives within the Omaha community. And diversity, equity, inclusion is one of the three strong legs of this stool of our Omaha 2040 priority. We also have an organization called the Empowerment Network that's really building out community scorecards, and we're going to present that today, the community scorecard around diversity, equity, inclusion, where employees of organizations, and you had to have 70% of your employees participate in the survey to be recognized, to give feedback on these elements of diversity, equity, inclusion. And so we're going to reveal today the community scorecard. And then there's a variety of very focused leadership development that the community is developing in the Empowerment Network with our minority mid-level leaders, our employees within the organization, and that's really important for this ongoing development, not only within the company, but also outside the company, to really understand the community impact. If you can go to the next slide, please. What we're also doing inside the organization, our board is committed to our commitment around diversity, equity, and inclusion. Our board has a resolution that they passed in July of this year around racism and our commitment to diversity, equity, inclusion. We also have 15 strategic directives, and one of them, Directive 8, is around employee relations, but focuses in on not just racism and sexism and homophobia and sexual relations, but also our commitment to the community around making sure that we are an inclusive organization. In June of this year, our organization had leadership huddles. We have 2 huddles a month with all of our leaders across the organization, and 2 of them in the month of June was focused on racism, where we had a deep leadership conversation around racism. And the second meeting in June, we brought in community leaders of color in that discussion, perspective for insight. And along with our African American network, and as you can see in this slide, we have 9 employee resource groups that we engage with very, very closely. And our African American network we are working with them to create a town hall on racism, that we'll be doing a virtual town hall with all of our 1,800 employees to talk about racism and the impacts of that, not only within our organization, but within the communities that we serve. And then the focus of our employee resource groups, you can see them there. Our Society of Engineers, specifically our Black engineers, are actively involved in ABE. And as I heard Paula talk, one of our Black engineers that have participated over the last 4 or 5 years in ABE, Maurice Kimsey, is also part of a mentoring project relationship with me. So our executive team is involved with our employee resource groups. They are the executive sponsors of these groups, so we have executive presence. We can make sure that we are, from a corporation perspective, engaging in the conversations across the organization. If you could move to the next slide, please. What we're doing inside our organization are some really unique things. We are doing gatherings and roundtables. So we have our professionals of color and our women professionals. Starting last fall, we began to do gatherings of these employees to begin to talk about their challenges within our organization, but even together, and how they can create cohorts of support across this organization. These gatherings are also part of identifying a specific project to help us improve within the organization. As of this slide, we had 82 employees that have participated. We have another 30 that have essentially went through the 3.5-day engagement on these gatherings, but it's an opportunity for us to get input, insight, and perspective. And myself as the CEO and president of this organization, I get the opportunity to meet individually with each of the employees that participate in the gatherings. And these are facilitated by an outside consultant that is just exceptional about creating positive cohorts. And they are doing some amazing things within our organization and providing the leadership team with amazing insight. We also started last fall, including my participation in White Men as Full Diversity Partners Labs. We now have 5 cohorts where we're taking our male leaders through this to really explore white male culture, white privilege, sexism, racism, homophobia, really begin to do a deep immersion and begin to create a conversation, a leadership conversation about what we need to be doing in our organization. And it really is changing the dialogue. It's changing the actions that we're seeing in our organization in a very positive way. And as I said before, we are having some very courageous conversations about us flying the Pride flag in June, but also about the racism town hall that we're going to have, what will also include other community leaders and certainly leaders of color that will give their perspectives and insights to our employees to begin to have that discussion and dialogue. And that's very important for us to continue that conversation. If you could go to the next slide, please. But as we begin to think about capacity building for the future, I think as Paula talked about, we've had a long tenure and relationship with Inroads, which is really targeted at college-level students, really in that professional area. And our focus has really been around STEM. And so over the course of years, we have continued to engage students at freshman year in college, in internship and co-ops, and many of them stay with us. They have the opportunity to really understand what we do, an opportunity for us to see their commitment to the work that we do and the way that we serve our communities. And many times, those employees continue to stay on as full-time employees with OPPD, and many of them have moved on within our organization in leadership and other significant professional roles. But in 2017, we started something called our Legacy I3 initiative. It's our opportunity to really focus in on underserved areas in our community, where we targeted juniors and seniors in high school. You know, we certainly do a lot of STEM-related work with our Society of Engineers and our young professional groups within our grade schools to talk about energy and STEM, as Paula Glover talked about. This is really about how do we begin to form juniors and seniors in high school about the work and the careers that we have within our organization. So we have about 20 to 25 students per year. And so we are in our 3rd year in which we have a cohort that's kind of going through a personal development boot camp this fall. They're assigned an ambassador. And in the 2nd semester, they will go through a deep career exploration of what careers they are interested in. Many of them follow through on 2 years at our community colleges, either in trades or in their associate arts degree, but many of them follow through and are going through a 4-year commitment at our local universities and other universities. And we continue to employ them in part-time and help them with their educational financial commitments as well. To date, after our first couple of years, we've had 3 full-time employees, 2 of them in our call center and supporting our call center, but also 1 as a line technician that just passed through our line technician boot camp and did just an exceptional job. Those are the commitments that we're having about continually building capacity for the future, not just in that entry-level area, but also in every level of our organization. So if you go to the last slide, I just want to say thank you very much for the opportunity for me to represent Public Power, but also represent the great city in the region of Omaha, Nebraska, and the great work we're doing around diversity, equity, inclusion. So I will be leaving around 9:15 Central Standard Time, 10:15 your time to kick off our second day conference, but would love to have the opportunity for additional conversation if you so desire. Thank you very much and have a great day.
Thank you, Tim. Ray?
Good morning, all, and I'll add my thanks, Chairman or Commissioner Berkovitz. Thank you for the invitation to speak today and for highlighting this really important topic in our industry. Thanks also to Chairman Tarbert and Commissioners Benham, Stumpf, and Quintens for your continued leadership and for making the time to talk about these very important issues. Most importantly, thank you to your teams for the work that they do in service to our country. I'm grateful for the opportunity to talk with you today about promoting diversity, equity, and inclusion within BP and in the industry. And I want to be clear as we start that I know that at BP we do not have all the answers. We've got a lot of work to do, but we're taking steps, and we are on a journey to get this right. I want to give you just a bit of context about BP and how this fits in to our identity. At BP, we want to be an energy company with purpose. Our purpose is to reimagine energy for people and our planet, and our ambition is to be a net zero company by 2050 or sooner, and to help the world get to net zero. We aim to be a company that's trusted by society, valued by our shareholders, and motivating for everyone who works here. And we know that in order to achieve this, our purpose has to go further. It has to be about improving people's lives. We want to help people improve their lives through the products and the services that we provide, and to improve their lives from our presence in local communities everywhere we are around the world. And we know that our presence matters in good times and in bad. Following the murder of George Floyd on May 25th, just a few days later, our CEO, Bernard Looney, sent a note to all staff to sharpen our focus on racial justice. Bernard also talked about our company's desire to help the world build back better in response to the COVID-19 crisis. To us, building back better means restarting the global economy in a fairer way, in a way that's more inclusive, more sustainable, more resilient. I believe we'll get there, but it might be helpful to give you some context of my own personal journey with diversity, equity, and inclusion at BP. I've been with the company for 30 years, and I say often that for all of that time, I've really believed that our company has had extraordinarily good intentions on diversity and inclusion, but we just haven't always effectively executed against those intentions. There's been a gap between who we were and who we knew that we could be. I'm an engineer by training, and I knew that our rigorous commitment to performance was underpinned and sustained by data. So why not take the same approach to the way we work in diversity and inclusion? In 2016, I decided to issue a challenge to my leadership, and I wrote a memo outlining how I thought we could do things differently and how we could better leverage data on hiring, promotions, and other areas to accelerate our progress. And before I knew it, I'd memoed myself into a new job as our Chief Diversity Officer. While engineering and operations had been the foundation of my career, diversity and inclusion has become my mission and my purpose. And since taking on the role, the movement towards a data-driven approach has underpinned everything we do to make BP an even more diverse and inclusive workplace where everyone is valued. Delivering on our good intentions perhaps matters more now than ever before. And while the world faces a host of challenges, there's an opportunity to build back better for those with the courage to act. This summer, there were a few steps that we decided to immediately take for all U.S. employees when we saw the opportunity. In June, we observed Juneteenth of this year as a day of reflection for all U.S. employees to give people a chance to pause and reflect. We added the Martin Luther King Jr. holiday as an official BP holiday starting in 2021, and we've prohibited the Confederate flag from all BP sites around the country. That was just a start, however, and in August we launched our framework for action. There's an old saying you probably recognize that it underpins the importance and the power of data in helping organizations achieve their goals and to deliver on good intentions. It's simply that what gets measured gets done. And I'm proud to say that BP is choosing to do just that with our framework for action. With the full backing of BP's leadership, this framework has 3 pillars: transparency, accountability, and talent. On transparency, our main commitment is that we're going to publish a comprehensive D&I report, both internally and externally. That'll come in early 2021 alongside our annual corporate report and our sustainability report. We want a data-driven approach that gives plenty of visibility and ultimately leads to real accountability for the agenda. And on accountability, we'll clearly link the progress in diversity and inclusion to performance management and indeed ultimately to compensation. Within BP, we're continuing to build an inclusive environment and will increase dialogue and education, including a focus on anti-racism. On talent, we'll drive increased hiring and progression of African Americans and other underrepresented groups. We know that can't happen without increasing the diversity of our talent pools. We'll refine the metrics and processes aimed at increasing the diversity of our talent pools and our candidate slates. And a big part of this will be fostering more strategic relationships with universities, especially historically Black colleges and universities. This is just a start, and BP's framework for action is just that, a framework. But like the frame of a house, other essential components have to be added. This gives us the foundation and the structure to gauge how our aspirations and our good intentions will translate into tangible reality for everyone. What gets measured gets done. And our framework is giving us the tools to first measure the right things so we know that we can do the best things. There's plenty more to do, but I'm proud of our commitment to be better and to do the work to improve people's lives.
Thank you, Ray. Noha? Noha, I think you're on mute.
Oh, all right, can you hear me okay?
Yes.
Good morning. I'd like to express my sincere gratitude to the Commission for your focus on diversity and inclusion as part of this committee, as well as for giving me the opportunity to speak regarding the issue. I'm speaking on my own behalf today. These are my views and not the views of the company or the views of our membership. It is not lost on me that I'm here before you just weeks after Ruth Bader Ginsburg, a Jewish woman, became the first woman to lie in state since the first person, Henry Clay, received the honor in 1852. It took 168 years. Ruth Bader Ginsburg is famously known for saying, "We'll stop when there are 9." She was correct, and her legacy certainly marks progress for women and minorities. We're slowly making progress. Actually, the phrase diversity and inclusion in and of itself is progress. My family moved to Omaha, Nebraska from Cairo, Egypt in 1991. I was just 9 years old, and as you can imagine, we were a little bit different, being the only Egyptian family in our neighborhood and one of only a few in the entire state. I didn't feel different. I felt like just any other kid, until one day my teacher pulled me aside and said, "One of the kids said that you don't like American kids. And you can't say stuff like that because then you'll never belong here." To which I responded, "Belong here? What do you mean?" And I never said that. I never even thought that. I was in 4th grade, still wrapping my arms around, and moved to a different continent, but certainly not old enough to grasp racism. Having only months before that lived in an entirely homogenous community. I didn't feel any different until it was glaringly pointed out. As I grew up, I had several of these character-building moments. I grew up to realize there was a whole anti-discrimination movement. Back then, it was anti-discrimination against women and minorities, meaning if they arrive at the gates of the job or the neighborhood, let us try not to treat them any differently. Now, 30 years later, the dialogue has changed to try to embrace women and underrepresented minorities. Today, we're trying to establish a platform for their success. We're trying to include them, be conscious of their culture and work needs. Today, we're aware of discrimination against a broader set of people and the need for a different cultural dynamic. It is no longer about treating us the same, but about diversifying the perspective and including us into the new normal. that will inevitably make us a more dynamic and richer nation. That's progress. As we have painfully learned over the last 6 or 7 months, creating a new normal is an uphill battle that glaringly points out our differences, not that dissimilar from the ugly and unfair comments made by my fourth grade teacher, but certainly far more amplified. We tend to measure the progress made by the number of minorities in an industry or the number of women in the C-suite. What's often lost is the number of people that don't make it, that don't have the opportunity to begin with. One lesson learned from the pandemic is that the human brain has a difficult time processing really large numbers or grasping exponential growth. We've lost well over 200,000 people during this pandemic, and at a certain point, 1,000 or 2,000 is much easier for a person to truly comprehend. So we have statistics such as 8% of the energy industry workforce is Black, according to a recent report by the nonprofit Energy Futures Initiative, while women make up between 23 and 32%. Not surprisingly, women make up a higher percentage figure in the renewable industry. In a 2017 report from the University of Massachusetts found that Black oil and gas workers earn 23% less than white workers in comparable roles. It's easier to think of or wrap our heads around these percentages than the number of candidates that get turned down or along the way never had the opportunity that puts them in the right place to get their foot in the door. The energy industry as a whole is making progress. Most of the large companies in the energy sector have instituted significant initiatives within their companies to promote women and minorities. EEI should be applauded for their board's recent endorsement of a diversity and inclusion commitment that builds upon the existing programs of their member companies. The energy industry is undergoing a significant change in how we serve U.S. customers. Renewable initiatives, technology and innovation are reshaping the discussion with the consumer. And part of that dialogue must be having a positive impact on, or at least an equal impact on, minority communities. A joint Tufts and Berkeley University 2019 study found that even when income is held constant, predominantly Black communities have almost 70% fewer rooftop solar installations than predominantly white communities. Diversifying the energy space at every level is key because it allows the industry to better serve the communities we're so proud to be a part of. I would be very remiss if I didn't address the fact that there are significant benefits to companies that make diversity a top priority. A decade's worth of research has demonstrated that while homogenous groups tend to reach consensus faster and feel more comfortable with their answers, they often arrive at the wrong answer. Diverse groups take longer to deliberate, feel less confident in the answer they have arrived at, but more often arrive at the correct answer. Further, a larger statistical study published in the Academy of Management Journal 2017 found that companies with women in their senior ranks contribute to the long-run performance by lessening the chances of risky strategies being adopted. According to a 2019 study conducted by S&P Global Market Intelligence, firms who appoint women in CEO and CFO positions are outperforming relative to their male counterparts and are boosting their firm's financial performance. The study looked at the companies on the Russell 3000 index that appoint new CEOs and CFOs. Over the course of a 17-year period, data found that female CFOs generated a combined $1.8 trillion, S with a T, more in profit excess than the sector averages. Firms with female CEOs and CFOs have produced superior stock price performance compared to the market average. In the 24 months post-appointment, female CEOs saw a 20% increase in stock price momentum, and female CFOs saw a 6% increase in profitability and 8% larger stock returns. These results are economically and statistically significant. I'm not overly surprised by these figures, because in my experience, you have to overcome so many obstacles as a woman to get those positions that you almost have to be so much better than your male counterparts. The bar is so much higher, it's almost unfathomable to think that you could do worse. Indeed, there are significant benefits to the bottom line, but a lot of work lies ahead. One particular area remains starkly undiversified, where the focus on diversity and inclusion remains weak. It also happens to be the area I'm most versed in, which is the lack of diversity in the commodity trading space in general, and certainly in energy. I run a small energy trading company. Our team's in the process of raising our first fund. for the last few months, I've done countless pitches from single-family offices to some of the largest investment firms in the country. I've spoken to one woman. As part of our pitch, we're aiming to raise 25% of our funds from women and underrepresented minorities and have set a goal to hire 25% female traders. The response to that slide of the pitch deck has been extraordinarily interesting. It's usually a pause at that point of the deck, which is often punctuated by my stating that it's a goal and a high priority for us. And the response is usually something like this. If you can do that, that's terrific. Or the more honest ones are, where are you going to find them? Or I have a daughter, wife, fill in the blank about important female relatives, and I'm happy to see stuff like this. When I composed the slide, I thought people would stay silent on it. I didn't think it would elicit a response that it was a difficult goal or a show of societal progress. To me, that says we need to do a lot more work here. Even in drafting my comments for today, I worry that the wrong investor with deep pockets, most likely not a woman or underrepresented minority, will watch this and say, I don't want to invest in that much. Are my public statements at a pivotal point in the company's success a hindrance to our future? I guess I'll tell you in 5 years. I've been in the commodity space for over a decade. Things have improved, but I'm still too often the only woman in the room. According to a 2018 Bloomberg article, in the top echelons of leadership of the world's leading commodity trading firms, only 5% of the leadership positions are held by women. On the trading floors of even some of the largest commodity trading firms in the world, out of hundreds of traders, there may be 5 to 10% female traders, if I'm being generous. I've done a lot of research and I couldn't find a thorough academic study on women in the commodity trading space. This is not to say that women are not working at large commodity trading firms, many with a focus on energy. Those firms have employed women. We are often found in compliance departments, HR, legal, maybe even in the C-suite as the token woman. We're seldom found managing the trading operation, or even a group of traders, making the allocation decisions, or even being groomed or mentored as a quant for a trading role. I've interviewed a few female traders that seek me out because they're tired of the culture on the trading floor. I've also interviewed countless trading groups, folks that want to come over as a group because they find more success working together. None of those groups have included women. To me, that says we need to make some changes on our trading floors. We need to give women and minorities the space to be in those roles and encourage a more inclusive culture on our trading floors. I urge you as the regulator to join me in asking the commodity trading community in general, in particular in energies, to focus on mentoring women and minorities to eventually be placed in higher earning roles and to creating an environment that doesn't just focus on anti-discrimination and increased percentages, but instead fulfills the progress of the phrase diversity and inclusion. With that, thank you for the opportunity.
Thank you, Noha. Lopa?
Great. Good morning, Commissioner Berkowitz, Chairman, and Commissioners. Thank you for the opportunity to participate today in this important discussion. I'm here today on behalf of the Edison Electric Institute, or EEI. EEI is the trade organization for the U.S. electric companies in the United States. Our members provide electricity to about 220 million Americans and operate in all 50 states and the District of Columbia and are regulated at the state and the federal level. As a whole, the electric power industry supports more than 7 million jobs in communities across the United States, and EEI members are committed to providing affordable and reliable electricity to customers now and in the future. ESG, or environmental, social, and governance issues, are a priority to EEI and its member companies. Environmental criteria can be used to look at how a company performs as a steward of the natural world, and historically has been the most prominent sustainability concern for our industry. EEI's member companies are in the middle of a long-term transformation in how electricity is transmitted, generated, and used. As a result of this change, the mix of resources used to generate electricity in the United States has changed dramatically over the last decade and is increasingly clean. Starting in 2016, natural gas surpassed coal as the main source of electric generation in the United States. And in 2019, natural gas powered 38% of the country's electricity compared to 23% for coal-based generation. Over the past 8 years, more than half of the industry's investments in new electricity generation have been in wind and solar resources. And nearly 40% of America's electricity is generated from carbon-free resources, including nuclear energy, hydropower, solar, and wind. These changes have had a profound impact on the sector's carbon dioxide emissions. Overall, at the end of 2019, emissions from the electric power sector were 33% below 2005 levels, their lowest level since 1987. Collectively, EEI member companies have reduced their emissions by approximately 45% since 2005. This trend will continue as more than 40 EEI members have announced forward-looking carbon reduction goals, half of which include a net zero goal by 2050 or earlier. As a result, EEI members are on a path to reduce carbon emissions by at least 80% by 2050 compared to peak levels in 2005. Social and governance components have increased in prominence in recent years. Social criteria, for example, can be used to examine how a company manages relationships with its employees, suppliers, customers, and the communities in which it operates. Governance topics can relate to a company's leadership, executive pay, audit, internal controls, and shareholder rights, among other board level and management decisions. The financial community has become increasingly interested in ESG issues over the past few years. For example, all three of the major credit rating agencies are considering ESG. Each is taking a unique approach, ranging from determining what is financially material to include in ratings to creating a separate and distinct ESG rating or grade. As the most capital-intensive industry in the United States, EEI is working with its members to provide relevant and standardized ESG data and information to the financial community and other interested stakeholders. In 2016, EEI and its member company ESG Sustainability Committee began to meet with major institutional investors and other relevant stakeholders to solicit feedback on how the industry can continue to respond to investor needs for ESG information. Outreach was conducted with investors, proxy services, ESG data providers, credit rating agencies, and other trade groups. Our member companies worked with the financial community to develop a voluntary ESG sustainability reporting template that meets investor needs by providing concise information in a consistent format. The ESG template is a first-of-its-kind voluntary sector-wide template. It is data-driven and provides consistent information across all of EEI's member companies. As such, the template promotes greater transparency and comparability, and it also enables companies to disclose information related to their long-term sustainability outlook, governance, and oversight strategy. This voluntary reporting is not financial in nature and is in addition to and outside of any reporting that member companies already do to the SEC on financial reporting issues. The voluntary reporting template has positioned the industry well and is focused on two overarching sections. A qualitative section, which is intended to highlight the ESG sustainability governance strategies in a brief 2- or 3-page summary, and an Excel-based quantitative section, which includes standardized metrics on generation capacity, emissions, human resources, water, and waste, as well as specific metrics related to natural gas distribution utilities. The template is now used by over 90% of EEI's membership and is achieving our objective of providing a specific set of the most relevant ESG metrics to investors on a consistent basis. And then just as with environmental goals, EEI member companies are also making progress on diversity and leadership. EEI member companies are leading other Fortune 500 companies on diversity and leadership positions. As of 2019, regulated electric companies had 20.9% female CEOs, 28% female board members, and 24.8% minority board members, compared to 6.6%, 22.5%, and 16.1%, respectively, for Fortune 500 companies. The template is a work in progress. We are now beginning a version 3 revision process, which will be released next year for disclosing 2020 data and information. Our members have also been working together on initiatives to improve diversity and enhance the disclosure of diversity information in the workplace and throughout the supply chain, with key focus on workforce welfare and racial equality. Now, recognizing that there are various inputs into electric generation, EEI has embarked on a joint initiative with the American Gas Association called the Natural Gas Sustainability Initiative, or NGSI. The goal of NGSI is to create an overarching ESG sustainability reporting program for the entire natural gas value chain, with the goal of creating a voluntary framework for disclosing consistent company-level ESG information to investors in a concise and consistent format. NGSI is broader in scope and more ambitious than the development of the EEI ESG template for two reasons. One, the NGSI will include sustainability practices, which goes a step further than just disclosure by also asking the gas industry to take actions to become more sustainable. And two, we are also talking about the natural gas operations across the entire supply chain. So we need the cooperation across multiple sectors for this to be successful. So we are trying to make participation in the early stages fairly simple by starting with only methane intensity, as this is the most prominent issue for investors and other stakeholders. Going forward, we would like to include other ESG topics, such as worker safety, community impact, governance practices, and board composition, as well as other E issues, such as impacts on water resources. The NGSI program has been in work in progress for about 2 years, and we plan to launch the version 1 NGSI methane intensity measurement protocol later this year. So EEI and its members continue to be engaged on ESG issues. So we thank you for the opportunity to participate today, and I look forward to any questions and to the discussion.
Thank you, Lopa. Melinda? Melinda, please go ahead.
Thank you. Can you all hear me all right?
Yes.
Okay. Thank you. Good morning. My name is Melinda Prudencio. I'm the Chief Risk Officer at the Energy Authority, and I thank Commissioner Berkovitz, the Chairman, and the entire EMAC for inviting me to be a panelist today. I also want to thank Abigail for her efforts working with us to bring this together as well. For those of you not familiar with the Energy Authority, we're a public power-owned nonprofit corporation with offices in Jacksonville, Florida, and Bellevue, Washington. As an energy trading and risk management company, we provide portfolio management, analysis, and advisory services to help our clients maximize the value of their assets while meeting their goals. At the Energy Authority, we recently went through an extensive strategic planning process with our board of directors and formally launched the plan in May of 2020. In the midst of COVID, we were able to still launch it. As a part of this strategic plan, the Energy Authority has committed to formalizing our environmental, social, and governance program. Although we have several initiatives, ESG initiatives already in place, this is really a deliberate focus to make ESG goals intentional and more formalized, to expand upon what we have in place and to continue to include additional meaningful programs. To start, I'd like to cover our rationale in creating an ESG statement. TEA is not publicly traded, and we're not doing this to gain investors with the use of ESG statements or programs. But having an intentional focus on ESG initiatives is critically important to us nonetheless, and for these three reasons. We recognize we are stronger and smarter when we have a diversity of voices and thoughts at our table. Therefore, we feel passionate about inclusion and collaboration and want to ensure that's reflected in our values. Secondly, is to ensure that we are responsibly sharing the values held by public power and the local communities that we serve across the country, which is more of a Main Street focus than a Wall Street focus. And number 3 is to attract and retain talent who value this as part of a corporate culture. So starting at the environmental component of this statement, first and foremost, we are in the energy industry and we represent over 50 public power utilities with a very broad diversity of assets. But we are the market interface for our client organization and do not directly generate energy ourselves, although our clients do. Our clients are located anywhere from the Southeast throughout the Midwest and all the way to the Pacific Northwest and pretty much everywhere in between. We have every geography and most every state has different requirements, resources, and economics at play. We actively help our clients navigate the choices they have when selecting new resources or retiring older resources in their portfolios and continue to support their decisions throughout and after their selection process, but we do not take a single point position on any of the type of energy generation over another in any of our clients' portfolios. But focusing more on the Energy Authority's specific footprint as a services organization, we have done several things to try to be good stewards of our resource use. And our continued programs, include recycling in our office spaces, reducing paper products, going more electronic, reducing travel where we can, and installing water bottle fillers, those sorts of things, those sorts of, small grassroots programs. But taking it further, things we're looking at include carbon offsets for conferences, continuing reduction of travel, reducing energy consumption in data centers and office spaces as well. Moving into the social component of the statement, which considers the company's business relationships. As a services organization, TEA is people. We treat our employees, how we treat our employees is a reflection of who we are. We are a performance-driven culture, and we know the value of supporting the whole person. That includes ensuring equitable pay, education, health benefits, time off to recharge, and an opportunity to develop both personally and professionally. He very consciously participates in volunteering efforts. Some examples include on the national level, participating with American Public Power Association's Day of Giving. TEA has sponsored this several years to give back to local communities that are host communities for the annual event. We also provide leadership and support for the MIT Hackathon. And more community-based, we support local give-back efforts, and we're very involved in university partnerships to develop financially based professions and the students coming out of those programs. We've even sponsored a trade floor lab environment at a local university to give students real-world trading and investing experience. We also encourage a lot of board involvement. We host women in leadership forums and participate on several women in energy boards. We support collegiate scholarships for first-generation students pursuing STEM degrees and work on several university business advisory councils. Employee health and safety is also key to our programs, and we try to provide flexible work programs for both hours and locations, which has absolutely been used a lot during the COVID period. We provide health and wellness initiatives for staff and have a very open and adaptable PTO policy, paid time off policy for personal needs to provide adaptability to our staff. But to really focus on the diversity inclusion component of the ESG program, this is critical to TEA, the Energy Authority. I'm sorry, I keep using TEA as our acronym. As we are a highly collaborative organization, we recognize that we have far more innovative thoughts and have greater outcomes when we have a diversity of opinions and ideas represented in our team. Although we're a relatively small company at 220 employees, we have become intentionally more diversified through the years. I can speak that within my area alone of the company, we have approximately 25% minority or international staff. We recognize this is just a starting point, and one of our ESG goals will be to work on continued integration of additional diversity of thought as we move forward. But to briefly mention one of our successful legacy diversity initiatives is our Women in Our Workforce and Leadership Positions, the Energy Authority. We took a very focused approach to increasing women in the workforce, and this initiative has greatly changed the makeup of the firm. Starting at the top, I'm proud to say that we have a female CEO, Joni Teofilo, who's listening in on this meeting today. She was promoted to the position from within, having run the trading analytics area and also a trade desk, as well as the middle office, to name a few of her roles through the company through time. And as Paula Glover mentioned at the beginning of this panel, promotions from within are a meaningful factor at the diversity and inclusion initiative levels. Currently, we're about 38% of the executive team being female. Again, these were promotions from within the company, growing employees and providing a development path for women at the firm. Looking back 10 years, the women in leadership roles at the company was a mere 14%. So we're approaching tripling that level. The work in this space is not done, but looking back on the results, it's given us fuel to continue to forge ahead. And as Ray Dempsey mentioned in his remarks earlier in the panel, what gets measured gets done. The final component of our statement, the governance, speaks to board leadership, and it's a foundational principle for the Energy Authority that we're a fully transparent organization to our clients. This is one of our hallmarks, and it's been something that set us apart from many other market interfacing energy companies. From a political perspective, the Energy Authority is not a lobbying organization. Due to the diversity of our clients and their very resource mix, local communities, geographies, and policies, we're often very supportive of their initiatives, and we can help what they are driving, but we do not take advocacy positions of our own or on their behalf. And board governance is a representation of each of our member owner utilities, and they are representations of their communities. The board members come to the board table wearing their own company's hat, so to speak, but are also keenly aware to put on their Energy Authority hat to ensure that we are making decisions and guiding the organization in a manner consistent to drive its success. So in conclusion, to wrap up my remarks on the panel today, the Energy Authority has several ESG efforts already in place. But I will echo what several other of the fellow panelists have said today, which is we recognize this is just a start. As part of our strategic plan, we are transitioning from an organic approach to ESG practices to a more focused and intentional deployment of ESG programs. We will leverage our unique culture and our innovative workforce and young workforce in a lot of ways to explore and expand our efforts into areas that are more meaningful to our employees, our clients, and our board of directors, engaging all levels of our staff in developing ESG programs moving forward, making sure that we're including everybody. We are fully committed to the belief that we are stronger through our diversity of thought and look forward to implementing more programs that promote inclusion and collaboration among our team. Thank you all.
Thank you, Melinda. Bill?
Good morning, Mr. Chairman, Commissioner Quintan, Commissioner Benham, Commissioner Stumpf, and Commissioner Berkovitz, and fellow members and associate members of EMAC. I am Bill McCoy with Morgan Stanley, and thank you for this opportunity to speak about Morgan Stanley's ESG initiatives. Financial services firms are in a unique position to promote environmental, social, and governance initiatives. As a global financial services provider, Morgan Stanley partners with clients and stakeholders to mobilize capital at scale to tackle global sustainability challenges, including climate change and inequality. The firm is deeply committed to delivering long-term value for clients and shareholders in ways that benefit the environment and society. Climate change is an economic reality, and Morgan Stanley supports the transition to a low-carbon economy through policies, activities, products, and services that help mitigate climate risks and catalyze market-driven, low-carbon innovation. The firm publishes analyses to help clients and stakeholders navigate the low-carbon transition. To reduce our own footprint, we aim to achieve carbon neutrality for our global operations by the year 2022. The firm is committed to mobilizing $250 billion to support low-carbon solutions by 2030. And last month, Morgan Stanley announced its commitment to reach net zero financed emissions by 2050. The firm recently joined the Global Steering Committee of the Partnership for Carbon Accounting Financials. Morgan Stanley will lend insights and expertise to help PCAF develop the global accounting standard that can be used by all financial institutions to measure and reduce their climate impact in their financing and investment activities. In response to the events of 2020 that have focused attention on racial and social injustice in our society, much of the financial services industry have responded by revisiting and increasing their efforts on their diversity and inclusion initiatives. Morgan Stanley has had a long-standing commitment to diversity and inclusion with a focus on our employees, our suppliers, and the communities where we work and live. Our skilled and creative workforce is comprised of individuals drawn from a broad cross-section of the global communities in which we operate and who reflect a variety of backgrounds, talents, perspectives, and experiences. We pursue a comprehensive diversity and inclusion strategy based on 4 pillars: accountability, representation, advancement, and culture. The firm's culture is defined by our core values and inform our employees in everything we do. Toward that aim, this year, we added commit to diversity and inclusion to our existing core values of doing the right thing, putting clients first, leading with exceptional ideas, and giving back. While commit to diversity and inclusion has always been implied in the core value of doing the right thing, this year's events underscore the importance of making it an explicit core value of the firm. Driving awareness of and accountability for diversity and inclusion efforts among managers across businesses is key to making progress. Morgan Stanley conducts annual diversity reviews to actively monitor representation as well as the impact of promotions, hires, and attrition on its talent pipeline. By sharing this diversity information with managers firm-wide, the firm seeks to drive governance and accountability. Hiring and supporting the careers of underrepresented groups supports business success. To build a diverse talent pipeline, we use global targeted recruitment and development programs to hire, retain, and promote women and multicultural talent. These professional development programs help employees to hone key skills, build networks, and gain exposure to senior management. We partner with organizations that support recruitment of female and minority career reentry candidates. Our campus recruiting efforts have also fostered diversity among entry-level staff. Amid growing evidence that diverse organizations often outperform their peers, Morgan Stanley employs policies and practices, including those on pay, that help attract, retain, and advance underrepresented talent. To promote equitable rewards for all employees, including women and ethnically diverse employees, the firm has enhanced robust practices to support fair and equitable compensation and reward decisions based on merit, ongoing review of compensation decisions, including at the point of hire and promotion, and regular assessment of the firm's reward structure. An inclusive, collaborative workplace helps to generate stronger work and results. Employees are encouraged to get to know colleagues who do not share their background, seek input from a wide range of individuals, and embrace opportunities to publicly recognize teammates, especially those who are underrepresented at the firm. Morgan Stanley also supports a popular global network of close to 20 employee affinity groups, which hold year-round networking and professional development events and enable colleagues across business units to share ideas and experiences. And we value diversity not only among our employees, but in every aspect of our business. For example, we actively seek out diverse-owned companies that can meet our business needs through our supplier diversity program. We work with a variety of these companies to foster strategic business relationships, which in turn stimulates the growth of many small businesses and drives economic development in local communities. Small multicultural businesses can face significant barriers to success in their early stages. The Morgan Stanley Multicultural Innovation Lab serves as a tech accelerator for startups led by multicultural entrepreneurs. This program pairs the entrepreneurs with seasoned in-house professionals to break down those barriers to success. The firm provides access to capital and expertise that many diverse founders lack. The lab connects these founders and their teams to the resources they need to grow and scale their businesses, along with an initial equity investment. The entrepreneurs then have the opportunity to pitch to a network of investors, potential business partners, and customers to take their companies to the next level. Finally, our efforts to promote diversity and inclusion extend beyond our own walls. Wherever we operate, we seek to actively support diverse communities by sponsoring prominent organizations and events, and by taking a public stand for inclusion. Some examples for the last 2 years include donating $1 million to the Hispanic Federation's campaign for an even brighter Latino community focused on education and service programs, promoting LGBT marriage equality in Japan by leading an initiative within the foreign banking community to express public support for the American Chamber of Commerce in Japan's viewpoint on marriage equality, committing $1 million to Catalyst, the global women's advocacy and research organization, and committing $5 million to the NAACP Legal Defense Fund, firms also matching dollar for dollar U.S. employees' contributions to the fund. Morgan Stanley also joined an open letter to the legal community, which the general counsels of 12 financial institutions published on September 30th. It memorializes our commitment to various diversity and inclusion goals based upon 3 pillars. The first is focused on internal action, such as enhancing opportunities for racially and ethnically diverse individuals within our corporate legal departments. The second is focused on external supplier engagements, such as working with law firms and other legal service providers to increase diverse representation on our matters. The third is focused on social action efforts, such as ensuring that our pro bono and other outreach efforts assist disenfranchised communities. Through pro bono and skills-based volunteering, Morgan Stanley supports a number of programs allowing its employees to make a lasting impact with local nonprofit partners. Supporting local communities is a priority year-round, but each year the firm strengthens the impact that its employees can make during its dedicated Global Volunteer Month. Over the 15 years of this program, Morgan Stanley employees around the globe have delivered more than 2.4 million hours of service. Thank you again for permitting me to discuss these ESG initiatives, and I look forward to any questions and further discussion.
Thank you, Bill. At this time, I would like to open the floor to questions and comments from associate members on these remarks from our first panel. And if you would please use the chat feature to indicate to Abigail if you have a question or a comment that you wish to make.
I have not received any questions, but if anyone would like to, apologies, I have a question from Delia Patterson.
Delia? Please unmute your line and proceed. Abigail, is there anyone else? I'm not hearing from her.
Commissioner Berkowitz has a question.
Commissioner, please go ahead.
Okay, I think I'm back on. Just like to thank everybody. Those were excellent and very informative presentations. I have a question, Noha. On your presentation, you talked about specifically one area of challenge, particular challenge. I think even in the challenging sphere, I think you indicated there were particular challenges on women and promoting diversity in energy trading in particular. And I'm wondering if having been in that sphere yourself, you might be able to expound on that, and whether you think the lack of diversity in trading actually affects trading itself and perhaps risk taking, whether there's certain just be blunt about it. I mean, trading is often viewed as sort of this macho, risk-taking, hard-charging culture. I guess perhaps these days, in many instances, it's become more quantitative and quant-driven and algorithmic-driven. But still, to the extent you have traders making trading decisions and a trading culture, whether how the diversity issue may affect actually how trading is conducted, and so I'd be really interested in your further thoughts on this area.
Absolutely. Thank you very much for the question. So I do think that we're going through a little bit of a transition in the trading world, at large, and also in energies, and that you're right, we are transitioning from, I got my buddy this job and I'm teaching him how to trade, and here's kind of how we do things on the floor. That doesn't really exist anymore. We're transitioning to more of a quant type model, which I think it creates an opportunity. There are a lot of women that are coming out of the math and science and computer science world that are really interested in this space, because it is, particularly in energies and at least in power, there's an opportunity to really also have a social impact, and that, our trading does drive value for the consumer. And it does, result in a lot of investment in renewables, which is why we're seeing a large pickup on environmental products, which we covered, I think, 2 committee meetings ago. So there is that aspect of it. But you're right in that there's still a little bit of machoism on the trading floor, and I think that's what companies really need to focus on. Is how do we make sure the women that we are bringing in at the quant level are able to fit in on the dynamics of the trading floor. I'll tell you, when I started as general counsel of a trading company, 8 or 9 years ago, it was a little bit difficult to fit in on the trading floor, because you got kind of the usual male comments when you walked onto the floor, until they realized, that wasn't going to fly with you. So a lot of it was kind of making your own inclusion, and now we have to focus on that being a broader company effort of companies ensuring that their female employees feel comfortable and their minority employees feel comfortable on the trading floor, also that they have that opportunity. There just aren't a lot of recruiting efforts to integrate women on trading floors, and I think that needs to change. And as far as how does that drive the trading, I absolutely think that it's a different perspective on risk. In fact, when I built my company, one of the major mantras was, the first thing we're going to do is establish a significant risk platform that goes on to all of our algorithms. And I think that comes from my legal background of being risk averse. Obviously I can't say that's true of every female trader, but I think just having that different perspective as you include more women and more minorities, you just naturally add more perspective to the dynamics on the trading floor. And it, is it going to make it less conservative? I think it depends on the company culture. But more conservative, I think that depends on the company culture. But I think in general, just having that different perspective is another way to view the trade. I'm not sure if that fully answers your question.
No, yeah, thank you. That's very helpful, very, very interesting. Thanks.
Thank you.
Abigail, the operator may have been able to switch Delia to this line. Could open up to Delia.
Okay. Delia, please go ahead.
We actually disconnected and is going to reconnect to the WebEx audio.
Okay. So Delia did send me her question separately. She said, in Ray's opening remarks, he noted what gets measured gets done. Melinda Prudencio noted it as well in her remarks. Delia would like the panelists to address what they think would be important to be measured as we move toward a more diverse and inclusive workplace.
Would anyone on the panel like to respond to that?
I can. Thank you for the question. It's important, and I have to admit there's probably many layers in my view about the things to be measured. Some things are the sort of obvious, simple things like representation, but there's more, and oftentimes it's the contributing elements, the things that you do as the inputs that can matter even more to the ultimate performance and progress. At BP, we have two ambitions, as we call them. One is a global gender ambition, and it's aimed at improving the representation of women in leadership in our company. It's due to be achieved by the end of this year, and I know that we've fulfilled at least one component of it already and hard at work at trying to close the gap for the balance. But we won't finish with this ambition. We'll reset an ambition early in the new year to help us continue to increase the representation of women at leadership in our company. In the United States, we have a U.S. minority ambition that was launched in 2017, and it's aimed at increasing the representation of minorities at all levels in our company in the United States. And I'm delighted that we've actually achieved that ambition, which was due to be achieved by 2025 already. And similarly, as with the global gender ambition, we'll look to reset our U.S. minority ambition for further progress in the new year. But we don't stop there. We examine our inputs around recruiting, the applicant flow. We pay attention to the performance rating outcomes of our employees around the country. We look for indicators about who stays and who leaves. We look for information that will help guide us in just employee data around satisfaction with our company. And we look at that across various demographics to ensure that we don't see issues that warrant specific intervention. When we say what gets measured gets done, we really mean it in a very broad way. And so what we are trying to do is ensure that we have a real business-like approach to understanding what will make us be successful at being a more diverse and inclusive company. I hope that helps.
Melinda, did you want to answer that question as well? I think you're on mute, Melinda.
Certainly. Am I back now? Okay. So we're not nearly as far along as defining our goals as Ray is at BP, with the exception of the women in energy piece. And as Noha mentioned, historically, trade floors have not had a high representation of women on the trade floor. We didn't set a specific number in hitting a target. We just had a very conscious goal of increasing women in our space of the industry. And that's when we began reaching out into, the women energy forums and getting engaged with different women board opportunities to try to incorporate more influence of women in the industry, and also working on ensuring that our promotional opportunities included, eligible women throughout the organization. And there's been several efforts made internal on that. And like I said, having a focus on that has produced the results that I feel are very, very strong, especially given our industry. So although I don't have a complete menu of what our next targets are, since we just released our strategic plan and we're just working on this component of it now, I would definitely say that, whatever you pay attention to, whatever you set your goals on is what you pay attention to, you will see the results on it.
Thank you. Abigail, do we have anyone else who has a question?
I just wanted to make sure if we could hear Delia, if she had any follow-up questions, comments.
Yes, I appreciate Ray and Melinda's thoughts. I was just wondering if Paula might have some recommendations on, what should be measured. Obviously, the numbers in terms of, how well folks are doing. And I think Ray also mentioned, satisfaction and the like. Just anything else, I'm taking notes from my own organization.
Sure, and thank you so much, Delia, for the question. I think what I would add to what Ray and both Melinda said is that I think there's that quantitative, the numbers that are in your data, but the qualitative is equally as important. So doing culture surveys and understanding, as I talked about inclusion, the culture of your organization, I think is really kind of the first step of where you are and what is baseline. What I've heard from some leaders is that oftentimes what we list on, what I would say on the wall as our values, may not necessarily be in our culture at every level. These are large organizations, and so you may see it at the top, but do you see that same kind of value exhibited, at the very first level, the frontline workers of your association or organization? And so to me, it's a mix of both of those things that you need to measure, and that you do need to be pretty specific. I think the other side is really around your supplier diversity numbers, and how you're doing in each different category, if you have multiple categories, and understanding how people categorize themselves. I will give you an example. If you look at me as myself, I could really, if I had the certification, fit in every single level, right? So I could fit as a woman-owned business, an African-American-owned business. I could fit as a service-disabled business, a veteran-owned business, LGBTQI. And so understanding what those different categories are, where businesses fit, and how they categorize themselves, if that's by certification, and then kind of building out from there. Those will be the other things I'd suggest.
Thank you.
Thank you, Paula.
Abigail,
I don't have any from. Oh, sorry. We have one question from Sarah Smolty at BP.
Oh, okay. Sarah?
Hi. I noted that several of the speakers discussed the importance of offering diverse candidates opportunities for advancement. And I like Bill McCoy's note that Morgan Stanley is offering opportunities for diverse candidates to gain exposure to senior management. But I know our younger employees at BP have expressed concern about being able to interact with senior leaders during this period of working from home during COVID. And I was wondering if any of the speakers have any recommendations for providing employees with these opportunities, especially during COVID.
Does anyone from the panel want to begin?
So I'll take a stab at it. I mean, we're all in a Zoom virtual world, and I think it also creates an opportunity for leaders to connect with employees very differently. And it may be doing listening sessions, sometimes during work hours, sometimes maybe even after work hours. But for younger employees who certainly are probably far more technology driven, kind of using either your internal intranet, doing brief Zoom calls, little, listening sessions with very small groups of people. I think those are other ways that you can connect, and employees can connect with leaders in a way that is super thoughtful. I think for leaders, really what the challenge is almost sometimes convincing people to trust that these conversations will be productive and have a particular outcome. Because you just don't necessarily know how people are coming into a conversation and how willing they are to be open based on what they think the response may be. And so I would say to leaders who are going to embark on that, it's important to be, I think, particularly sensitive and maybe have a heightened awareness that employees may not necessarily see you the way that you see yourself. And so there may be a gap there that you're going to have to try to bridge.
Bill, did you want to answer as well?
Sarah,
yes.
I'll jump in, even as your colleague. I'm sorry, Bill, I didn't mean to interrupt you, but I'll add a quick point and then hand it back to you. I have to admit that during this pandemic time, it sometimes does feel a bit difficult to stay connected, but in a strange way, I find that I still do it quite a lot. Later today, I have 3 get-to-know-you sessions that have come from my offer, my invitation to people. And I think there's sort of a double edge to the recipe that makes this sort of thing really, really work. I think leaders have to be really clear with the offer and the invitation to make themselves available, and then they have to actually follow through. When someone says, hey, you said that you were open to having a conversation, I'd love to get some time, you have to do it. And that's what I think is a really important part of my responsibility, but frankly, it's one of the most important and valuable things that I spend time on. And for younger people who are looking for those opportunities, I guess I just have to encourage them to be courageous. And something I often say to people is, I don't know of any leader. I have no colleagues who have ever said, no, I'm not interested in talking to you when a person said they'd like some time. The struggle may be that they have to say it'll be next Tuesday and, at 3 p.m, because that's just the first available slot in the calendar. And as long as we're both sides are willing to take on that flexibility, I think it can still be very richly rewarding. I make no guarantees or promises about the usefulness or the value of my input or my advice, but I always learn from those conversations, and hopefully I'm able to contribute things that help other people on their journey. Bill, again, I'm sorry for the interruption. I'll turn it back to you.
No, actually, it's a good transition, Ray. Thank you, because really I'm just echoing what Paula and Ray have said, that we are living in a Zoom environment. I think very early on it was recognized within our institution and others that it was important, particularly for the managers, incumbent on the managers, to reach out to teams, to keep people together through video conferencing and the like. And I agree with you, Ray. The junior staff should be encouraged to reach out. It's really incumbent on the managers to make sure that they stay connected in bringing the teams together, either one-on-one or collectively as teams, so that people feel connected as people working from home. Thanks.
Thank you. Abigail, are we ready to move on to the EMAC members now?
Yes, we can move on to the members, and Derek Salmon from CME Group has a question or comment.
Okay, Derek, please proceed.
Hi, thank you, and good morning. I want to thank the participants for what has been a really thoroughly engaging discussion on this important topic, and I'd really like to share a couple of comments from the CME perspective about how we think about diversity, equity, inclusion in our firm, but really want to start with applauding the Commission for setting up this panel and elevating the discourse of these issues across this industry, using this as a platform for both information sharing, best practices setting, and being able to learn from our peers as to what learnings people have applied over the last number of years on their own D&I journeys and where that's taking them. This is an area of particular interest for me as I sit on the executive committee of our Global Diversity and Inclusion Council. I'm committed to helping our industry, not just our firm, make progress and further progress in this area. At CME Group, we believe in advancing policies that strengthen the integrity of our global community, from workforce empowerment to corporate stewardship to community commitment, sustainable solutions, a lot of what we heard about so far on the panel today. As the ESG movement continues to gain traction and momentum globally, we've been actively engaged in various ESG activities for a number of years through our corporate social responsibility initiatives, addressing sustainability issues through our ERM programs and otherwise. We've also worked to continually contribute and improve on these important issues. We recently completed a competitive review of how others in our industry, as benchmarking matters a lot, are managing and reporting on their ESG initiatives, as well as a materiality assessment to identify, define, and prioritize the social, environmental, and governance issues that we can make the most impact in and that matter the most to our key stakeholders and constituents. Going forward, we've committed to reporting on our progress in a cohesive and actionable framework, a lot of what we heard from the success of the companies we heard today. In fact, our first annual ESG report was published just this past summer, and we're also developing an enhanced ESG disclosure framework on our website, and all these efforts are subject to oversight of a board level that has prioritized this as well. It's our intent to enrich the broader conversation around ESG, both within our company and across the industry. Ultimately, we believe this will further strengthen trust in our organization among our key stakeholders and positively impact the communities in which we live and work. Importantly, and we heard a lot of this from everyone who spoke today, our employees are the biggest part of our success and really creates momentum for us within CME Group. We engage with and empower our employees through a number of what we call employee network groups. Some people call them employee resource groups, but we refer to them as employee network groups. We have a total of 10 of these groups, the first of which was established back in 2012 under the WIN group, which is the Women's Initiative Network. We have groups all the way through different constituencies across our client base globally. We have a group called BOLD, which is Black Organization for Leadership and Development. We've got a group called CAN, which is our Connecting Asia Network, and all the way through PRIDE, which is our LGBTQ community, and OLA, and our Hispanic groups. So we, like others that we've heard today, hear a lot about the importance of empowering and building up and enabling growth and opportunities and mentorship within and across communities in the organization, both vertically and horizontally. And that's a big part of what we're focusing on. So again, I want to thank the Commission for expanding the dialogue on diversity and inclusion, allowing us to hear from each other what those best practices are, how to impact positive change in our industry, and raise the bar for ourselves and each other to continue to make progress down our own individual firm journeys that reach an aggregate benefit to net outcome for everybody. So thank you for the time, and I look forward to the balance of the conversation.
Thank you. Abigail, do we have any questions from the other EMAC members?
I don't see any questions from the other members at this time, but Commissioner Benham is on the line. He would like to share a few words.
Okay. Thanks, Abigail. And I just want to jump in. I missed my opening statement. I was on a panel starting at 9 o'clock as well, and couldn't grab the opening statement slot with the EMAC. So I just want to say hello to everyone. Thank Commissioner Berkovitz, Abigail, Dina as well for running this. It was great to listen. I joined about 45 minutes after, but to hear some of the conversations from the energy space, and then Morgan Stanley as well, and CME more recently. So an issue I care deeply about, and all the E, the S, and the G are very important. It's great to hear from the end user community and our market participants what everyone is doing. This is a collective issue, and it's good to hear that we're all on board and trying to tackle them, ask the right questions, and address them. So thanks again to Commissioner Berkovitz for raising awareness and having this discussion, and certainly look forward to the balance of the morning's conversation. Thanks.
You know, we have a question from Rob Kramer.
Okay, Rob?
Hi there. First of all, thank you for for hosting this important conversation today. I really enjoyed hearing from everyone. This certainly is a very important issue throughout our industry, and we at the PTG certainly take it seriously, and many firms are working on initiatives to try to strengthen the diversity, inclusion, and equity in our firms and across the industry. I'm wondering how people feel about the perception of trading in society impacts the type of applicants to our industry.
Anyone who would like to respond?
So I'm happy to take a stab at that. It's really interesting because as somebody who's done recruiting for my former company, I think that I would get all these folks that would come in and say, trading's really interesting, but I really want to be an investment banker. I'm weighing this offer against investment banking. So I don't know that kind of like the stigma against trading and being in finance, I think we're starting to lose a lot of that. And I think because of the transition to more quant and more algorithmic trading, more of a data-driven focus, we're losing some of that like perception of machoism on the trading floors, and people are recognizing like as part of the financial infrastructure, I can do a lot of positive. So I've definitely seen the tone change over the last 10 years. The other thing that I think is kind of interesting, and I always point out to people when we go to meetings and they say, well, aren't you guys like Enron or these financial traders, we get a lot of that in the power community. And it's very unfortunate because when you look at the data, we really do drive a significant amount of cost saving to the customer. And regional markets that have less liquidity, the market participant or the customer pays significantly more, or states that lack retail competition. So that social good is definitely there, and we just need to, I think, be stronger in conveying that message out to folks. But I always tell, when we get that kind of feedback, my response is always, well, if you don't like financial institutions, do you have a mortgage, do you have a credit card, have those things helped you move ahead? We need this framework in order for us to really be successful as a country.
No, I wholeheartedly agree and appreciate your comments there. I feel like the most of the big kind of news articles and things that come out are always about some nefarious activity or some event in markets, and I don't think young kids who are making decisions about career paths, things that they want to pursue, have a really accurate perception of how important markets are in society today for the average person, and how they can be involved and do very good work using markets, understanding markets, and participating in financial markets. And I feel like things have shifted, as you pointed out, from the trading floor to where we are today in terms of how trading is conducted, and there's so much opportunity for people to get involved.
I agree, and I hope you continue to spread the word too. I'm certainly trying to do that.
Thank you. Abigail, do we have any other questions?
I do not have any questions from any of the members at this time.
Okay, I'll turn it back to you.
Thank you, Gina. At this time, the EMAC will take a brief break. EMAC members, associate members, guest panelists, and commissioners, please keep your phone on mute and turn off your video during the break to expedite a return at 11:15 to begin the second panel. Thank you. Thank you. I would like to call the EMAC back to order and turn the agenda back over to Dina.
Thank you, Abigail. Our second panel today will provide a survey of ESG derivatives products listed on 3 exchanges. Our speakers are Derek Salmon, Senior Managing Director, Global Head of Commodities and Options Products at CME Group, Stephen Hamilton, Global Head of Financial Derivatives, ICE Futures US, and Megan Morgan, Global Head of Equities and Index Sales with Eurex Exchange. Derek?
Great, thanks, Nina, appreciate it. And thank you to Commissioner Berkovitz for inviting me to present to the committee here this morning. Thank you as well to Chairman Tarbert and the other commissioners. I'd also like to thank Abigail and your staff, Commissioner Berkovitz, for, as usual, herding the cats to get these presentations to come together so seamlessly, so thank you. We appreciate this opportunity to share an update on some of CME Group's products that help market participants manage emerging and increasing ESG-related risks. I'll cover some of what we offer today, but I also want to emphasize our ongoing commitment to developing ESG derivatives as our clients' risk management needs evolve and shift going forward. I'll begin with a few overall remarks about how we approach product development in general and then specifically in the area of ESG. More and more, market participants are considering ESG factors as part of their overall investment strategy. In addition to presenting on our ESG futures this morning, I'll focus a little bit today on the E in the ESG as climate-related risks continue to present an increasing need for risk management, particularly in the commodity space. As the MRAC subcommittee's recent report on managing climate change risk in the U.S. financial system also points out, we believe this is an area where innovative derivatives products can and should be part of the solution. CME Group offers benchmark futures and options in some of the areas most affected by climate change, such as fossil fuels and agriculture. It's important to note that our portfolio of risk management products is designed to help global customers manage price risk in today's energy and agriculture ecosystem, while also enabling market evolution towards alternative sources of cleaner energy and sustainable agriculture. We continue to develop and enhance new products across asset classes, which can help customers manage risks associated with renewable energies and environmental change as we transition to a more sustainable economy. We do not believe in a build it and they will come approach to product development. Instead, we use a consultative process, regularly seeking customer input and feedback to understand the gaps in the market and the developing products and services in partnership with our customers that address those specific needs in both today's world as well as as the world evolves. To illustrate that methodology, I'd like to spend a few minutes talking through a couple of examples. Let me start with ESG futures. Interest in ESG investments has accelerated over the last year as overall awareness around ESG initiatives has increased and as ESG indexes, which are more exposed to tech rather than energy and industrial, have been outperforming traditional indexes. This has contributed to increased demand for our E-mini S&P 500 ESG futures. In fact, in just the last few weeks, we saw an increase in volumes and open interest, with open interest increasing by about 20% just in the last 10 days. We launched our E-mini S&P 500 ESG futures contracts back in November 2019 as our first equity product in this category. These futures contracts give clients exposure to the S&P 500 listed firms that meet ESG criteria that align with the investment decisions in either the personal or institutional values. This product is a cash-settled futures contract based on the S&P 500 ESG index, which is a broad-based market cap-weighted index designed to measure the performance of securities meeting sustainable criteria and excluding those that are involved in things like tobacco, controversial weapons, or greater than 5% of revenue from thermal coal, or a low United Nations Global Compact score, all while maintaining similar overall industry group weights as the S&P 500. As of September 30th this year, there are 299 companies in the S&P ESG index, including Cme Group. We launched these contracts based on customer demand for ESG derivative solutions. Participants in our market, while currently predominantly European-based asset managers, we're continuing to see growing interest from U.S. clients as well. We also have insurers and hedge funds involved in this product, and banks are facilitating liquidity as well as proprietary trading firms providing on-screen liquidity on a global basis. Our futures contract currently trades an average daily volume of about 500 contracts, and open interest is about 4,800 contracts, representing about $720 million. Since launch, we've engaged with our customers to get their feedback on how they approach ESG and how we can continue evolving these products to meet their core needs. Each client's approach to ESG is different. Some are looking to use ESG futures in the dedicated ESG funds, while others have said they're using them within their non-ESG funds to help improve the portfolio's overall ESG score. One other challenge for ESG investing is that there's no commonly agreed standard on categorizing ESG, which means each asset manager can be in a position to be finding that on their own. In fact, some asset managers even are resistant to having a single standard because they're able to market their individual standards as a promotional element and differentiation to attract new assets. As the S&P 500 is the world's most widely watched equity index, we're hopeful that its ESG version will become a similar market standard. The ESG space will continue to evolve. We're encouraged by the early participation in our offering. We look forward to evolving this market further in partnership with our global customers. Turning now to the environmental side, we want to talk about a little bit of our ESG-related announcement that we recently made, which is us working on launching the first ever futures contract on water, designed to help not only the ag market, but also industrial and commercial water users. With nearly 2/3 of the world's population expected to face water shortages by 2025, water represents a growing risk for businesses and communities around the world. Our new water futures contract will provide a regulated, market-based solution for managing risk in the most active and dynamic water markets in the U.S., which is in California. This will be a cash-settled product based on the NASDAQ Veles California Water Index. Each contract will represent 10 acre-feet of water. The index sets a weekly benchmark spot price for water rights in California based on the volume-weighted average of the transactional prices in California's 5 largest and most actively traded water markets. NASDAQ developed this index in partnership with Veles Water Limited, a firm specializing in the development of financial products for water markets. The data utilized in the calculation of the index is provided by West Water Research, an economic consulting firm focused on the pricing, valuation, and transaction advisory services for water rights and water resource development. Going forward, we believe a robust, transparent market will help to create a forward curve so water users can hedge future price risk. Our contracts will be listed with 8 quarterly expirations, and the term structure across the curve will provide useful data that could potentially lead to more efficient and sustainable consumption decisions around managing the price of accessing water. We hope to launch this product later this quarter pending regulatory review. Beyond water, we're working with producers and commercial participants across all commodity segments to develop a derivatives products from used cooking oil to liquefied natural gas, from copper to palladium, all of which play a role in these sectors as they transition. In closing, I hope these examples give you an understanding of just a few of the ESG products that Cme Group continues to bring to market. We believe that derivatives play a key role in helping market participants better manage climate-related risk and facilitate price discovery today and going forward as we transition to a greener and more sustainable future. And with that, I'll turn it back to the committee. Thank you.
Thank you. Stephen?
Thanks, Dina. Thank you, Commissioner Berkowitz, Chairman, and the rest of the EMAC for the opportunity to talk to you, and to Abigail for organising me. Is my slide deck ready to go? The title slide. So if I start by introducing myself, my name is Stephen Hamilton. I'm the Global Head of Financial Derivatives at ICE. I'm here today to talk to you about the ICE futures offering in terms of ESG listed derivatives products, specifically the ICE MSCI ESG Index futures listed on ICE Futures US. The first slide that I'm going to talk to is entitled Tailwinds. So the demand and the noise around sustainable investments shows no sign of slowing down, and what we've seen during 2020 and its impacts on society has likely helped focus the importance of environmental, social, and governance factors on companies' performance. There's been numerous reports on this over the last 6 months, which I don't plan to recite to you, but the effects on global supply chains, energy usage, treatment of the workforce have all come to the fore as real non-traditional risk factors. And on this slide, I've noted the fiduciary and regulatory requirements of businesses and the need to mitigate those risks, especially reputational. But all of this stems from the last point on the slide, which is that it's driven by client demand. So as new investors come to the market, armed with more information, they're making more demands that their money is invested wisely and in line with their beliefs. But there's also increasingly demand from current old money, if you like, because strong ESG scores are highly correlated with above average returns in the medium and long term. So the takeaway from that is, while regulators around the world are increasingly taking measures to bring more transparency and standardization on how investment firms integrate the ESG factors into their investment and risk processes, client demand and returns will always be drivers of investment activity. Next slide, please. So ICE serving global markets. I'm going to talk to the ICE offering more broadly. I apologize for the busy slide here. We're quite a busy organization. If we start with the premise that ESG investing is a process that requires access to relevant, transparent, and standardized tools, from data to tradable products, ICE has developed ESG solutions across the different business lines, as you can see here. So the New York Stock Exchange, a global leader in raising capital, works with listed companies, sharing knowledge and encouraging reporting on ESG. As a data provider, our ICE Data Services Group offers access to standardized ESG reference data and works with our clients to design tailor-made ESG indices that can be used for performance measurement. And finally, on the derivatives trading and clearing side, where I sit on the exchange side, ICE exchanges have long provided investors with the tools to transition to less carbon-intensive fuels with our carbon emission derivatives in Europe, a market we've been in since 2003. And more recently, we partnered with MSCI to launch futures on the MSCI ESG Leaders Indices and MSCI Climate Change Indices. Next slide, please. So why MSCI for our ESG index futures? Our current suite of ICE MSCI index contracts have become key instruments used by institutional investors for their equity allocations. An interesting measure of that can be found in the CFTC trading report, showing that about 72% of both our EM and EFA futures open interest is held by asset managers or institutions, long developed or emerging market equities. And both of our EM and EFA futures products are amongst the top 10 equity index futures in the world by open interest. MSCI is the world's largest provider of ESG indices. They calculate more than 1,000 equity and fixed income ESG indices, and they have 30 years experience in the area. MSCI launched the first socially responsible investing index in May 1990, the MSCI KLD 400 Social Index. Approximately $13.1 trillion in equity assets under management are benchmarked to MSCI indices as of the end of last year. Of this, approximately $220 billion in institutional, retail, and exchange-traded fund assets are benchmarked to MSCI ESG indices. So while that's currently only about 1.7% of the total, it is rapidly growing. Requirements for asset managers are also fast evolving, and at ICE we work with our customer base to ensure we offer a suite of contracts that enables them to easily implement a change of asset allocation policy or transition management cash optimization. A recent example of this, which was in the press earlier this year, the Danish labour market pension fund, PenSam, said it has switched weightings in its passively managed listed global equities portfolio to take account of climate factors by adopting the MSCI All-Country World Index Climate Index for the whole €4.8 billion allocation. Move to the next slide, please. And I'll talk about why we chose the ESG Leaders methodology. Again, I apologize for quite a busy slide, so I'll try and summarize quickly. We chose the Leaders methodology owing to there's a comprehensive set of exclusion criteria applied. So excluded are producers of nuclear power, alcohol, gambling, tobacco, civil firearms, excludes any ties to any controversial weapons or companies involved in severe controversies. And it has a best-in-class approach. So the indices select the highest ESG-rated companies in each sector of the parent index, and this is reflected by the assets under management gathered within the segment. If we move to the next slide, please, we can talk about some of the challenges before moving on to the opportunities within ESG. It seems from people that I speak to, the single biggest challenge brought up in connection with ESG is standardization, or perhaps the lack thereof of consistency in ESG ratings and index providers. The challenge for us as an exchange is to create a market around a set of widely used benchmarks. As ever with derivatives markets, we'll see liquidity flow to the standardized and accepted products based on these benchmarks, which will go some way to address the consistency issues. We also see quite diverse ESG regulatory regimes. In Europe, the adoption is very much regulatory driven. Perhaps in the US, it seems that the regulatory investors are not as aligned. In the US, we have investors increasingly asking companies to disclose information related to ESG factors. BlackRock has gone on the tape saying it will avoid investments in companies that have a high sustainability-related risk. This is a move that Larry Fink says will fundamentally change how American companies conduct business. Conversely, the U.S. Department of Labor has had a more conservative view on the integration. On August 31st, the Department of Labor proposed a rule that would require retirement plans to only focus on issues that have an economic effect on a retirement plan, perhaps not taking into account ESG-related issues. These divergent approaches are certainly a challenge. If we move on to the next slide where we talk about opportunities, index providers will increase the transparency in ESG ratings and data. And since November last year, MSCI ESG Research has made ESG ratings of over 2,800 companies publicly available. Climate change concerns are very much back in scope. A survey published at the beginning of the year by the World Economic Forum showed that for the first time, the top 5 long-term risks perceived were all environmental. That's led to a growing demand for environmentally focused investments, obviously leading to an increase in number of financial products, but also a focus on those standards. And increasing regulatory and government action. For example, the European Union will sell 225 billion euros of green bonds to finance climate-friendly projects as part of the Pandemic Recovery Fund. That's it in terms of slides from me. Thank you. I hope at least some of that was useful, and I'll pass on the baton.
Thank you very much. Megan? Megan, can you unmute your line?
I can unmute and start my video all at the same time. Thank you, and thank you to the Commission for giving us this opportunity to talk about what we are doing in Europe. My name is Megan Morgan. I am the Global Head of Equity and Index Sales for Eurex. Eurex is, for those that don't know, Eurex is the leading European derivatives exchange across many asset classes, equity, fixed income, FX, and commodities. And while we specialize in European markets, we are also expanding our global footprint to other markets with our MSCI franchise. So today, I really just want to walk you through our ESG story over time, because I think it really will give you an idea of why certain products are gaining traction, why we list the products we do and in what order, and where we look to go in the future. And I have been told I have the gift of gab, and we have a lot to talk about in 10 minutes, so excuse me if I speak really, really fast. Our efforts in ESG really started in 2018 when we were approached by a Scandinavian asset manager whose company had decided that if they want to sell ESG funds, they need to be 100% compliant with their ESG principles in their entire portfolio. And what this really means is prior, of course, they were executing these ESG principles in their main investment strategy, which was 90% of the fund and executed in the cash markets, but not in their cash equitization leg, which was 10%, the remaining 10%, and done in standard benchmark derivatives. So when the PM went to roll his derivatives position, he found that there were no ESG derivatives to roll into. And he was at that moment limited to 2 choices: either keep the cash as cash or put that cash in the securities and just rebalance every day. The first was prone to tracking error. The latter prone to was very, very costly. So as a result, he went to the exchanges to list derivatives. And really, he wanted 3 things. He wanted liquidity, transparent order book pricing, and a recognizable benchmark that had an ESG filter in line with their house policy. But the message was very, very clear from him that when when it came to ESG needs in the derivatives market, right now liquidity and order book pricing had a higher priority than expressing a specific opinion about sustainability. So we use this as an opportunity to consult the market. I mean, as my colleagues from the other exchanges say, we don't make products in a bubble. We do it with client feedback, and if one asset manager is asking for this, there's likely a lot of others that are thinking about it. And so we mainly focused on the Scandinavian market, pension funds and asset managers, because they're really the epicenter of sustainable investing, but also talked to French and German asset managers and insurers as well. And what we found was that even without regulation mandating derivatives usage in sustainable investing, asset managers in Europe really believe it's their fiduciary duty to invest in a sustainable way. And they want to apply these ESG principles that they have developed in-house to as much of their portfolios as possible. But again, the message was clear over and over again. When it came to the derivatives market, liquidity and order book pricing were key. So as we all, as my fellow colleagues on this panel know, building liquidity in new products is probably the hardest part of our job. Derivatives markets don't grow in straight lines, they grow in hockey sticks. You get 2 traders, 8 traders, 20 traders, 1,000. And getting to that inflection point is really the main part of my job every day. So when we think about building a liquid ESG benchmark, we know that the only way to get to that inflection point is if investors truly believe that the underlying index provides a standard proxy for ESG investing. And in a world where there's no common agreement on the E, the S, and the G, let alone ESG, I mean, this is quite a challenge to find an index methodology that everyone can agree on. We looked at the range of the ESG investment strategies that we could list derivatives indices. And, obviously there's very, very targeted beliefs like impact investing to broad-based indices with simple exclusions, taking out baseline companies that everyone can agree are not ESG compliant. And what we found in this market consultation in 2018 is right now in this ESG investing life cycle, if we truly want to prioritize building liquidity in the ESG derivatives market, simplicity is the winner. Staying as close to existing benchmarks and finding common ground on what we should exclude. That is why, thus far in our product launches, we've mainly focused on exclusion indices, working with well-established benchmark providers like our sister company Stocks and MSCI. So these exclusion indices are norms-based screening, excluding out companies everyone can agree are not ESG compliant, gambling, controversial weapons, tobacco, thermal coal. In February of 2019, we launched our first exclusion index, the Stocks Europe ESGX. This is simply based on the Stocks Europe 600, a broad-based benchmark of 600 European companies, and excludes tobacco, controversial weapons, thermal coal, companies that are not in line with the UN Global Compact principles. Interestingly enough, in addition to the exclusion index, we deviated from our plan and also launched 2 indices based on integration methodology, so using ESG scoring as a way to build the index. The Eurostoxx 50 Low Carbon Index and the Stocks Climate Impact. And we did this because we had heard from the insurers in this consultation that they were really concerned about their exposure to climate change and wanted the ability to hedge this in the derivatives market. They also wanted to demonstrate to their investors that they were using a benchmark aligned with a climate taxonomy. Similar, you hear these names like Paris-aligned benchmark or climate transition benchmark, but again, knowing that liquidity and order book pricing were important, we built the low carbon index. It's as simply taking the Eurostoxx 50 and reweighting the 50 components according to their carbon intensity. So overweighting companies with low carbon footprints and vice versa. And the actual index lowers the carbon footprint by 63% based off of the regular benchmark. That said, we also heard from these same insurers the desire to hedge long-term risk, the climate of the future. And the Stoxx Europe climate impact takes the Stoxx 600 constituents and only keeps the companies that aim to have a low carbon footprint in the future. And we do this by using data from the CDP that looks at companies' forward-looking carbon emission footprint by looking at 4 data points: where the emissions are now, what does climate change mean to the company, how does the company manage climate risk, and what is their strategy to solve climate change in the future. Then they grade these companies A to D-, and we keep the best in class, which I think was around 233 components. So after the launch of these 3 indices in 2019, we only saw trading and open interest accumulate in the exclusion index. So the feedback from the market was very, very clear. It's just not ready from indices based on integration methodology. So our next step was to expand our exclusion footprint globally, and in Q1 of this year, 2020, we launched futures on Stoxx USA Exclusion Index and 5 MSCI screened indices. So this screened methodology, Steve talked about the leaders methodology. The screened methodology is MSCI's basic exclusion indices. And we launched 5: EM, EFA, World, Japan, and USA. Again, the goal was to find liquid benchmarks that asset managers were currently using and offer the same product with a slight ESG tilt. Again, MSCI's exclusion methodologies are in line with the same principles we heard from the European consultation: screen for thermal coal, tobacco, controversial weapons. MSCI also screens for oil sands, which isn't applicable to European companies. But one thing that I point out that's interesting is that MSCI screens for nuclear power, and in our consultation, we found that was not something we could screen for in a pan-European index, because nuclear power is just different opinions in Europe. You have a handful of countries like France and Finland and England that believe that nuclear power is the solution for the climate and have committed to even building more nuclear reactors as a way to get to a zero carbon emission footprint. And then you have Germany that believes it is a danger to the environment after Fukushima, and in 2011 actually committed to reducing its nuclear footprint. So now we're here, October of 2020, a year and a half later, after we've launched 10 contracts on 10 indices. We've accumulated 1.3 billion euro notional open interest in these contracts. However, 1.25 billion of that is in futures and options on the Stoxx 600 exclusion index. So what does this tell us? I mean, we have a small community of users in the Stoxx 600 exclusion index, banks, market makers, asset managers. So it's diverse. However, I would say that the desire to trade ESG derivatives is not yet translating into trading ESG derivatives. And partly I think this is because we have launched the indices of choice, the exclusion indices, but we're not at that inflection point of hitting liquidity thresholds where asset managers can get in. But partly is because the European market is very sophisticated. And those that want to trade, when it comes to ESG, and those that want to trade derivatives in line with these house ESG principles that they've created, have very different opinions and very strong conviction to those opinions on what defines ESG. And a simple exclusion index won't satisfy them. So now we're migrating into what we call phase 2 of our listing strategy, and that's to move away from exclusion indices and into integration, where we're using ESG scoring and positive screening to build indices based on ESG principles. We're starting to get to a place where ESG scoring is becoming more transparent, standardized, and accepted by the European market, and thus we believe the scoring methodology can provide that standard proxy to attract liquidity. In fact, this is a timely panel because in a couple of weeks, the beginning of November, we'll launch 2 new ESG indices using integration methodology based on the DAX and the Eurostoxx 50. So just to give you a little background about those two, of the next wave of the future, the DAX ESG will look at the universe of the HDAX, which is 100 German companies, first applies the basic exclusion screen, and also excludes nuclear power because in line with German customer principles. But the integration approach then looks at 3 data points: ESG scoring done by data provider Sustainalytics, order book volume, and free float market cap. And again, these are equally weighted because liquidity is just as important as ESG principles. The Eurostoxx 50 index is a fixed 50 component. It screens out the bottom 10% based on this ESG scoring, again, same ESG scoring, and then applies basic exclusion screens, keeps nuclear power because it's a pan-European index, and then looks at all the excluded companies by sectors and replaces them by best-in-class ESG, best-in-class companies based on their ESG rating. So that's really our equity and equity index portfolio, looking historically and what's in line to be launched. One phenomenon I want to draw to your attention, and I believe Commissioner Quint has mentioned this as a point of interest, is performance. You know, it's interesting because in our consultation, performance was never really one of the key drivers for designing these indices, nor was it a motivation to trade these indices. However, looking back on 2020 and you know, now post-COVID, post-mortem, these indices have been outperforming, and this is something that's getting noticed by the investment community. In fact, when we designed the DAX 50, one conversation we keep having is that this index would have never had a company like Wirecard, right? So performance is starting to become a conversation we're taking with customers as well. So just to round out very quickly, you know, we are a multi-asset exchange. We are looking at an ESG strategy with fixed income. It will mirror the equity index strategy, where we'll look at liquidity and price transparency as the priority, and use only benchmarks that we are familiar with across investment grade, high yield credit markets and across geographies. And then I just want to echo what Steve has said, and you know, when we look at the biggest hurdles and the biggest opportunity, I think the biggest hurdle is also the biggest opportunity, right? The EU has started to agree on a taxonomy, which kind of provides this common understanding of what is the E. Growth will only come when we agree globally. You know, there's an agreement globally on what is the proxy for E, what is the proxy for G, F, and what is the proxy for G. And, you know, provides a common understanding and standards of what activities are considered sustainable and worth investing. And then having the data to measure this, right? I mentioned our indices use data sources like Sustainalytics, CDP, MSCI, which in turn rely on corporate data. And we need the golden source for ESG data. This is just another tool for investors to really ensure they can quantify their ESG principles. And then for us as index providers and benchmark, they can measure their performance against the benchmark we provide. Thank you very much. I'm done.
Thank you. Now we'll turn to questions from the associate members to the panel, and I think we had a question from Dr. Sandor. Is that correct, Abigail?
Yes, it is. And the operator is going to just take a minute to connect his audio. He should be on shortly.
Okay.
His line is open. If you can unmute and speak.
Hello, can you hear me?
Dr. Sandor?
Hello?
Go ahead.
Yeah, can you hear me? Hello?
Yeah. So Dr. Sandor emailed me his question earlier, so I will begin, but Dr. Sandor, if you are able to start speaking, please cut me off. So AFX... Can you
hear me?
For 3 years, AFX has an initiative to try to get commercial relationships with these banks, which Dr. Sandor believes fits in with ESG.
Hello?
And Dr. Sandor, do you have any additional comments, if we can get you on the line?
Sorry, I can't. Can you hear me?
Yes, we can. Thank you. Please go on.
Oh, thank you. Sorry for the technical details, and I was not able, because of technology, for the last comment period on minorities. AFX, which is an exchange for regional, mid-sized, and community banks, developed a coalition of minority depository institutions. And 3 years ago, we took a look at the patterns of ownership and found that there were only 19 African-American minority banks out of 5,300, which identified the problem, we thought, in a nutshell. So we made a special effort to recruit Puerto Rican, Hispanic, African American, Chinese American, Korean American, and Native American banks. And were subsequently Ameribor, our successor to LIBOR, was endorsed by these minority-owned community banks. They lend money within the community and the PPP program. They made loans as small as $200 to salons and Atlanta shopping centers, etc. So they reached into their communities in ways they couldn't. We surveyed them recently, and they really don't need deposits. They're flush with liquidity, as most American banks are. But what they do need is equity, and they need to be employing that liquidity. And I wondered if any of the energy companies, utilities, oil companies, people in the energy sector have reached out to become customers of these minority-owned banks, to borrow from them, to give them services, because I think pound for pound, building up those folks and their ability to lend is a very, very effective way to help the minority communities. And I don't know if any of the energy companies or utilities are doing business with minority-owned banks, but wanted to suggest this is a pound-for-pound, cost-effective way to help out that community.
Thank you, Dr. Sandor. Did anyone on the panel want to respond to that, or do we have another question from an associate member, Abigail?
Thank you, Dina. We have a question from Dr. Parsons. Dr. Parsons, please share your question.
Mute on.
I can read, Dr. Parsons sent his question, so I can read verbatim. I'm interested in learning more about the water market and data on the water market underlying CME's forthcoming water futures contract. Is there any peer-reviewed research on that market and the spot price data on which the futures contract is settled? Westwater used to report its data publicly, but stopped doing so a few years ago. At the time it went dark, I wouldn't have thought that the data was suitable for a futures contract. I'm curious about what has changed. Just as an example, my understanding is that there are only occasional transactions and that the number of transacting parties is very small. Presumably data in published research could be a good corrective to any faults in my impression. I remember back to NYMEX's creation of the Henry Hub natural gas futures contract when it was first proposed. The CFTC turned it down because of issues with the underlying spot market, like the ones I'm inquiring about for this water market. Back then, an enormous amount of work was, and then the question ends. So if anyone on the panel would like to respond to that question, thank you.
Yeah, it's Derek here. Since it's our product, I better jump into that. So a couple of things. Like all of the price reporting agencies we work with, whether it's Argus or Platts or S&P or anybody else that we use for assessing markets and developing contracts, we have to adhere, I think, as the Commission knows, to all of the core principles in the CFTC rules and regulations, such that we need a sufficient amount of underlying data, we need a sufficiently reportable set of data points over the underlying market. So, I think you're absolutely right. A couple of years ago, this data was more sparse, and I think it was not usable and certainly didn't satisfy the core principal criteria that we have to adhere to. And then when we develop product and let it go to the CFTC for approval, they review that same underlying data set as well. So while I can't tell you exactly what Westwater did back in the day, a couple of years ago when they went dark, I assume they, like other PRAs, determined that the underlying methodology and the data capture business and the business of being a price reporting agency was a monetizable asset, and they decided that they wanted to not share that, distribute that publicly, but actually then build proprietary products on the back of that. What I can tell you is that that data set that we use is, as I mentioned in my comments, sufficiently populated for us to be able to determine a weekly calculation. We don't do dailies, and we also volume weight those to the extent that, obviously, if you have a very small transaction, a very large transaction, that volume weighted becomes an important part of that calculation process. So probably the two most important answers are yes, that data has gotten much more robust, and yes, we rely on our weekly assessments that we provide, not daily assessments, and that water market is still growing and emerging. Over time, we expect that market and the data points, particularly with the evolution of transparent lit markets like this product we're putting out there, gains traction. We assume that there would be more reporting on more data points as more data becomes available. So happy to talk offline about the details of what we can publicly. We filed and we're waiting for regulatory approval, but we're happy with the data that we've seen so far in the weekly assessment piece, and the robustness of the underlying data is sufficient for us to launch the product. So hopefully, Dr. Parsons, that answers the bulk of your question.
Thank you, Derek. Abigail, I don't see any other questions or comments from associate members. Do you have any?
I'm not seeing any at this time, but if anyone would like to turn their video on if they have a question. And additionally, if there's any commissioners that have a question or comment, please also feel free to share now. Commissioner Berkowitz has a question.
Yes, thank you, Abigail. Again, thanks to our panelists here for a really fascinating discussion and at the front edge of new product development. And I'm curious because maybe you all mentioned it, about the difference between the EU and the U.S. in terms of where this investment is coming from. I guess, could any of the panelists what are your observations on what's the difference between U.S. and European investors, and is this something that you anticipate in the U.S. will catch on or catch up, or is this are you thinking this is mostly going to be a European market going forward?
Sorry, it's Steve Hamilton, Commissioner. If I can have a first go at answering that. I think you're right, and I think we most of us did mention the divergence, but I don't expect that will continue. I think that the EU has been ahead, and it's been ahead because of the regulations that have been written early, and some of that is the requirements on firms to report on their sustainability, which I think is not far from becoming more standardized in the US. So I think there is a current divergence, but that is only heading one way, I think.
Yeah, it's Derek here. I would agree. I think that we weren't surprised to see the early adoption coming from European and almost exclusively asset managers. And I think just the expectation and the requirements under which many of the covenants of their investment fit make that a requirement in the U.S. I think that there's, I think about these as sequential, not parallel. I think as the European customers sort of plumb the path and create more demand, I do think that over time standardization is going to be critical. I think lots of folks are vying to become the standard or an alignment around standards, and that's becoming part of a problem for, broad-based derivatives to be built on the back of these. Listen, we've got, 5 million contracts a day traded in our equities complex. 500 of those are ESG futures. We've got 8 million contracts open interest in equities, and we have, less than 5,000 in our ESG contracts. So there's no question that over time that will be an evolution, but we also know that standardization and industry accepted principles around those are going to matter. As an aside, I spent a lot of time talking to investors and analysts that cover us, and increasingly when we talk to investors and analysts, it's as much about the, hey, how your product's doing, how your business is doing, but also they want to hear about how we as a firm, as an investment in and of itself, is satisfying many of the ESG criteria. We're spending a lot of time talking about what we're doing with our diversity inclusion, what we're doing with our sustainable efforts, what we're doing with our sustainable sourcing initiatives. So this is, we're seeing this expanded, and that primarily used to be a European analyst conversation. That is increasingly now part of our regular dialogue with the U.S. investors as well, not from the using CME product side, but investing in CME as a public company. So I think that pre-messages what to expect over time. But again, I think standardization is going to get us there. I think Europe's ahead, but I do think the U.S. is following, but not on its own parallel track.
Megan, did you have a comment?
I mean, no, I echo the same. It's the same. It's pretty much the same message. I mean, the one comment that when I talk to my colleagues internally, including, the head of our regulatory efforts, it's very interesting because usually Europe follows U.S. regulation when it comes to our, especially when it comes to our market. And this is for the first time where we feel like the EU is in the pole position to set the standardization. And that is really being driven by the way the investors are investing their money, especially with like I said, with the Scandinavians. They just have a very robust process in which they define ESG, the E, the S, and the G, and they've been thinking about this. I mean, this is hitting our radars in the past couple of years. But this is not a new phenomenon for them. They've been investing in this way for almost a decade.
Okay, thank you. Thanks.
Okay, I think we need to ask for any comment from the EMAC members, and I understand that we have one question. Is that correct, Abigail?
Yes, we actually have one question from Paul Ciccio, who's an associate member. We're slightly out of order, but we've been having some technical difficulties. I just wanted to open up and ask if Paul is able to speak, if he could speak now. If not, I can read his question.
Yes, can you hear me?
Yes, thank you.
Yes, all right. I love this panel, thank you. My member companies are very diverse manufacturing companies. They are primarily raw material providers, plastics, chemicals, cement, steel, aluminum. And so, you know, they produce the products that are then used in the, let's say, very top-of-mind environmental products like wind and solar. Well, with that given, you know, what is the correlation between the ESG indexes and the stock values of manufacturing companies? That's question number one. Number two, given the diversity of the manufacturing sector that I just spoke of, you know, it raises the question of, are there fair standards in measuring ESG? And then third, given the diversity of these manufacturing industries, do you have manufacturers, you know, companies on your advisory boards to advise you so that you have good information? Thank you.
Maybe I'll take a stab at number two there in terms of the kind of standardized ways in which firms are assessed from an ESG perspective. I think the short answer there is a qualified sort of. There are a lot of folks out there trying to determine that they are the authoritative determiners of ESG compliance. There are some very, very basic ways in which firms are falling under a general ESG score. The way a lot of those scores get captured, and there's a handful of firms that are out there that are sort of compiling these scores. Largely, they're sort of screen scraping websites, and they're pulling publicly available information about everything from population of boards and diversity to senior leadership through to employee relations issues, through to carbon neutral footprints and commitments to climate implications. And this one I mentioned, I think you heard all three of us talk about the lack of standardization, but the drive towards standardization. Relative to your second question there is not a standardized way in which there's a definitive scoring system for firms. And more frustratingly, the ways in which that information is captured and then entered into a scoring system for a firm is very limited at this point. I think a lot of firms, I mentioned in my prepared comments earlier, that we as a firm put our first ESG scoring report out there just this summer because we had recognized that as analysts are looking at firms and you're trying to clear screens as an investable asset, the ways in which we were making information available that certain screening firms are looking for to calculate a score, if they're not sort of found on your website, you kind of get a zero for them. So it's an evolving engagement with the industry. It's an evolving process of those entities that are scoring those firms and capturing the data and then calculating those as a score. So I think you'll see a lot more traction along those lines. And I think all public companies right now are determining how it is that scoring entities are gathering that information if they're not speaking directly to those firms. And how is it that they can make that information available so that those scores are correctly reflecting what individual firms are doing. So I've got some insight into that. As I said, I sit in our executive committee of our Diversity and Inclusion Council. I also sit in our steering committee for our ESG initiatives. And those are things that we've worked with third-party entities and consultants out there that are surveying this landscape and explaining to us how this is getting done and how the market has not coalesced around standards at this point, although there's no shortage of desire to do that. So hopefully that gives you a little bit of perspective on the second question of your three that you posed.
I think quite quickly, just as a quick comment to your question and concern, you know, one of the ways in which we have started, as I had mentioned, you know, in the first wave of indices is right now where the industry is at. We're making very simple exclusions that the market can agree on, and still there are some, you know, in Europe what we're seeing is there's still, it's not, even though that I would say is the farthest along in agreement, there's still disagreements on things like nuclear power. So when it comes to manufacturing, I mean, that is certainly one area that we just do not see standardized yet, just as Derek mentioned as well, that there is no standard proxy. I would say that while we are cognizant of that, when we discussed what I discussed the next phase 2 of our benchmark design, we are very cognizant that if we just do simple ESG best in class, we would screen out certain industries, and so what we're doing is making sure that the industries are properly weighted just as they are in the like for like benchmark, and then doing the methodology within to take best in class companies.
I'm not sure I have anything to add on manufacturing. I'd like to be able to come back on the question and have a conversation with the index provider on that specific subject. I will say that one of the subjects that we often end up talking to our clients about is sustainability and climate change, and why these things are in the news and an issue, and the problem that we're trying to address is not difficult through lack of motivation, if you like, but that perhaps the tools of that unsustainability are spread out over, what are we now, nearly 8 billion people, all enjoying 100% of the benefits of the actions of plastic bags, fossil fuel powered cars and homes, but only bearing a tiny fraction of the cost, right? So individually there's no economic incentive to take action, and that is known, or has been known in economics, as the tragedy of the commons, which was based on an old British economist whose name I regularly forget. So before this call I made sure I looked him up. He's William Lloyd. He hypothetically looked at the effects of grazing on common land in Britain, where cattle owners were able to graze on that land, incentivized to add one more animal without incurring additional cost until resources were depleted. Actually only became known as the tragedy of commons more than a century later with another article in '68. ESG looks to provide some information to help solve some of those issues, using regulatory and economic incentives for companies, and providing perhaps economic incentives to investors. But I think perhaps the short summary of that rather long answer is that it's very new. We're right at the start of trying to measure the inputs here, and I think we have a long way to go.
Abigail, do we have any questions pending from members or anyone else?
I don't see any questions from any members. I'm not sure if we have any questions from the commissioners.
Commissioners, anyone have a question or comment? Being none, I think we're ready to move to the third panel. Is that right, Abigail?
Yes, thank you.
Okay, thank you. Our third and final panel today will provide a staff update from the Risk Surveillance Branch within the Division of Clearing and Risk on initial margin performance in the energy markets between Q1 and Q3 of 2020. We'll hear from Saiz Srinivasan, the Deputy Director of the Risk Surveillance Branch and DCR, and John Paul Rothenberg, a Risk Analyst in the Risk Surveillance Branch at DCR as well. Saiz?
Thank you. I'd like to sort of start with thanking Commissioner Berkowitz for inviting us to present at today's EMAC meeting. Joining me in the meeting, the presentation will be John Paul Rothenberg. He goes as JP, who sort of works with us in the team. We'd also like to thank Abigail for all the hard work and helping us prepare for this presentation. just before we get started, I just want to sort of provide some context. A couple of months ago at the MRAC meeting, our staff had presented some high-level macro analysis of sort of the IM and VM margin flows that we had observed in the clearing system in March and April. In today's presentation, JP and I will sort of walk you guys through the margin performance of key energy benchmark contracts. You can go to the next slide. The standard disclaimer, the views presented by JP and me today are those of the staff and our views, and not those of the Commission or the Division of Clearing and Risk and so on. The Commission receives pretty granular data on margins and position information at account level of customers, clients, and we take a lot of care to ensure that the information we disclose sort of is consistent with the Section 8 of the statute, and we're not disclosing positions or transactions of market participants. So just want to highlight that. Next slide, please. So this might be the first time, at least from my recollection, that the team here is presenting to the EMAC. So I thought I should spend a couple of minutes sharing with folks as to what do we do. So this is the risk surveillance branch. We sit in the Division of Clearing and Risk. We call ourselves the quants in the Division of Clearing and Risk. And we can sort of break up our core function in sort of three different buckets. The first one is margin model oversight. As we all know, in the clear derivative space, if you cannot post margin, then you cannot transact. So initial margin is the first line of defense. And we have a dedicated team which looks at CCP's margin models, changes that they make to models, and also on an ongoing basis, doing analysis of the performance of margin models. And JP sits in that team. The second function that we perform is what I call the daily risk surveillance. This is, as I said earlier, we get end of day, every day we get position and margin information from all the CCPs for futures and swaps. And we have a dedicated team which does quantitative analysis. We are sort of looking for vulnerabilities at a product level, account level, and across futures and swaps and across all the different asset classes. And finally, this is a more recent development over the past 3-4 years, and the focus is on stress testing, supervisory stress testing. Till date, we have published 3 staff-level reports on supervisory stress tests done by CFTC staff. We typically are looking for systemic issues within CCPs. Do CCPs have enough pre-funded resources to absorb extreme and in some cases even implausible shocks? In addition to sort of these macro type and systemic type issues, we are also interested in assessing for vulnerabilities at the account level, at a product level, and we have developed a suite of stress testing capabilities that we use on an intraday basis. So that's sort of a quick overview of what we do. And with that, I will turn it to JP.
So thank you, Saeed. Hello, everyone. So I'm JP, and I work under Saeed in the risk surveillance branch, and I want to thank everyone for contributing their time and expertise to this meeting. It's been a really fascinating conversation to hear how industry is responding with new policies and products to what we're experiencing. So for this presentation, I'll focus on the somewhat drier topic of initial margins and how they perform for energy products in 2020. And I'll start by briefly touching on what IM is and how it fits into CCP risk management. Then I will show the energy sector size and composition in the futures and options market and how energy's performed on a product level earlier this year. And finally, I'll finish with some observations. Next slide, please. So risk management is a core offering of central counterparties, and much of their risk management efforts actually focus on monitoring creditworthiness and preemptively sizing credit exposures to prevent and minimize defaults. But in case of default, initial margin is seen as the blue part in this left chart, is the largest and most visible pool of capital and often represents 90% of pre-funded resources, as we see in this stylized example. Now, while IM is the largest pool, it's only the first line of capital that kicks in the event of an actual default. First, we see that a counterparty's IM, seen in green on the right chart, is designed to cover most of the risk that a CCP faces in reestablishing a market-neutral exposure post-default. But this is sufficient only most of the time. The remaining long tail of default risk is covered by the defaulter's guarantee fund contribution, the CCP's skin in the game, and the remaining members' guarantee funds in that order. If that is still not enough, CCPs have the power of assessment on their members for even more capital, depending on the number of defaulting participants. Next slide, please. So while we will be looking at IM at a product level, I want to stress that it's actually collected on a portfolio level. And for a given portfolio, we can use a histogram to kind of conceptualize the distribution of profit and loss. Here we see that most of the P&L is green, which indicates that it's covered by IM, but the larger and rare losses are shown in the left tail as orange. So if we rotate this chart so the orange point faces down and zoom in a bit, we can see more details about what IM should cover. Next slide. Next slide, please. There we go. So here, again, we're looking at kind of a rotation of the last chart, and the vertical y-axis is the hypothetical loss of a portfolio, while the x-axis represents the potential likelihood of that loss going from 5 times per year event to a 1 in 50 year event. And this is a student T for anybody that's interested. So the red line is the size of the loss, while the light green area is the portion of that loss that's covered by initial margin. So IM is typically designed to cover 99% of portfolio moves and the cost and impact of reestablishing a market-neutral position for the CCP after a default. As such, it covers most of the credit exposure most of the time, and on this chart, that's all the area to the left of the black line associated with 99% of P&L. Next chart, please. So, by design, some of those potential losses are actually not covered by IM because it would be capital inefficient. Now, to the right of that center black line, we see the worst 1% of moves. For daily margins, we expect to see these losses about 2 to 3 times per year. And it's important to stress that this is only a statistical expectation. So even exceeding this number of breaches occasionally is not necessarily a concern. Further, larger diversified accounts tend to actually breach less than the products that make up of those accounts due to conservative diversification assumptions. Now, so while IM covers the large portion of these losses, as represented by the green shading, we still expect losses over initial margin, as represented by the orange shading, to be covered by other capital that we mentioned earlier, such as the guarantee fund and throttled by credit limits. Further, the guarantee fund is actually sized to handle the simultaneous default of 2 clearing members with major mark-to-market losses at a minimum. So to summarize, IM is designed to cover most of the losses most of the time, but some breaches are still expected and are covered by other capital. So next slide, please. So here we're going to move into the specifics of the energy market, and we're looking at a highly aggregated estimate of how much market risk a contract represents for the first half of 2020 across major CCPs. It's important to note that this is a combination of all CCPs. So in cleared futures and options, we see that energy markets, as the red area on the left chart, make up about a quarter of the risk-weighted open interest among major CCPs. Then digging into energy exposure with the right chart, we see that WTI and Brent crude contracts represent about 30% of the energy space, while the main natural gas contracts represent about 10%. The remaining risk is usually made up of various tangential crude distillates and natural gas contracts. So next slide, please. So here we're actually then start digging into the performance of an individual risk factor, starting with ICE's Brent contract. We are looking at a rolling front month exposure with the bars representing the P&L of a single contract. The bars are colored red when a breach occurs. So here we're counting 2 breaches for long exposure in the first half of 2020. Dates associated with those breaches are also highlighted in red. Now, I consider long exposure a different risk factor from soda exposure, so we actually see 0 breaches for the shorts. Now, the gray line in the background is the price path and shows the kind of general downtrend in Brent returns. An important note here is that this is the price path of a rolling strategy and not the price level of the contract, which would be different due to the rolling conventions. Next slide, please. So here we simply layer on initial margin as gold lines in the top chart and can see that I steadily increased margins as 2020 evolved. We also include open interest in the days until expiration in the bottom to give us additional information about the rolling exposure and some sense of the dollar importance of a breach and how it related to expiration. So for this chart, we see that the front-run breaches did have significant open interest associated with them. Next chart. Okay. So finally, we add a P&L histogram to the left of the chart in light blue to give us some context going back to the beginning of 2018. So this suggests that margins were not very tight relative to history, as we see only a few ticks outside the starting margin levels. So 2020 has been a busy year in general and for energy in particular. We started with heightened trade tensions between China and a bull market that was one of the longest seen in history, and that was less than a year ago, even though it seems like forever. Then COVID started traveling around the globe and eventually spurred lockdowns and some of the most severe economic contraction that we've ever seen. Now, during this, oil-producing countries could not agree on production quotas, which then triggered a price war between Saudi Arabia and Russia for a time. So in this chart, we see that Brent, which is a benchmark for cash-settled European crude oil, responds to the Saudi-Russian oil spat price war with the largest down move over, and that was over twice any move seen since 2018. Now, ICE responded by gradually raising margins and fully covered some of the subsequent large moves. Now, margin for the front-month Brent contract ended up about 40% higher by the end of May than where it started in 2020. Next slide, please. So WTI experienced the same global macro factors as Brent, and we see the same March breaches that we saw in Brent. This was followed by 2 large whipsaw moves that breach as March expiry approached for WTI. Then we see a major breach on 4/20 the day before expiration in April. Now, CME was anticipating some issues and raised margin by 1,000 going into settlement, but the move was still 7 times what margin was at the time. Now, this April move was unique to the expiring contract, and no other contract along the curve breached. Since the contract was expiring, open interest was low at around 14,000 contracts, and there was no option risk as those had settled a few days earlier. This meant that the clearing system's exposure to the move was actually pretty limited. So in the first half of 2020, we count about 5 breaches for the long exposure and 1 breach for short exposure. Next slide, please. So next, we'll take a look at ICE's Henry Hub natural gas contract. The histogram at the top left tells us that natural gas experienced some very, very fat tails with multiple points outside of margin at the beginning of the year. Now, further analysis shows that actually much of this is due to seasonality. We can even see that margin for natural gas lowered from earlier in the year as the model priced in the typically lower spring volatility. We see 1 breach for the shorts on April 20th, that corresponding to the WTI settlement, and another breach on May 6th. So slight differences in, so let's move on to the next chart. So here we take actually a look at the CME's Henry Hub contract, which is a sister contract to ICE's. Of note, this is actually 4 times the size and is physically settled from ICE's contract. Now, the contracts move in lockstep, but with slight differences in the IM due to the discretion of the CCPs. So the 2 breaches, so here we see 2 breaches for the shorts and 1 breach for the long, but nothing concerning. So next slide, please. So finally, as a product level, we take a look at gas oil, which is an ICE Europe contract. And we see that the histogram on the left shows that margins were fairly conservative relative to history, with only one tick outside the initial margins at the start of Feb. The gas oil contract experienced 3 breaches for front-month long exposure, each day correlating with a large down move in Brent and WTI. But margins for the product were relatively stable, and there's really nothing concerning that we saw for such a dramatic event in the general and energy markets. So if we move on to the next slide, we're going to start taking a look at all those products in aggregate. So here we're looking at the relative change of margin levels across all the products we looked at. So margins for all products are indexed to 1 on January 1st, 2020. So a print of 2 would mean that margins doubled for that product. In oil, we see the green WTI line rise the most and peaking at over 3 times what margins started at the beginning of the year. The Brent contract in blue peaked at about 1.5 times what margins were at the beginning of the year. So by August, crude margins were off their highs, but still up about 1.5 times than what margins started for 2020, but have since actually come down to about 1.2 times what they started for in 2020. Now, while the WTI contract started with margins about 22% lower than the Brent contract, WTI briefly had margins 60% higher than Brent as the May expiry approached. And while related, WTI and Brent are significantly different products with different contract designs that resulted in different narratives for 2020. So much of the margin patterns then we see in natural gas are seasonal, which is why we see it actually decreasing in 2020. The margin performance for the 2 ICE and CME natural gas products are fairly similar, and they end the sample period down about 20% from where they started. So in general, margins rose, sometimes significantly during the crisis, but have largely retraced from their highs. The next chart, please. So finally, we'll take a look at the characteristics of the margin breaches we saw in aggregate for these energy products. So the top chart shows the P&L as a multiple of margin. So a mark around 1x means that margins barely breached. Please note that this is on a log scale. The size of the circle then gives us a relative sense for how much margin is allocated to that product at the time of the breach. So a larger circle is a larger product of open interest times initial margin. The bottom charts stack the amount of dollars each breach represents for the day, with the largest on the bottom. So WTI is green and Brent is blue appear to dominate the dollar impacts. Now, important note is that this is not actually any dollar loss that a clearing member or customer or CCP actually faced. It's just an estimate. So it becomes obvious then that the March 9th event with the large bar on the bottom chart was the most impactful from a systematic perspective and is shared largely by Brent is blue and WTI is green. Above the large bar, we see that Brent had more margin dedicated to it at the time of the breach than WTI, but WTI had a greater breach as a percent of margin. Now, jumping over to the April 20th event, we see that there is a small circle at the top of the chart at around 7 times for that WTI breach. Now, looking at the associated bar, we see that we see a significant dollar impact, but not something systemic like what we saw on March 9th. So moving on to the last slide. So this brief survey then showed us that multiple product levels breach occurred during 2020, but that's to be expected when a crisis unfolds. The histograms suggest that margin was not at cyclical lows, as we saw a few breaches stretching back to 2018. Additionally, while not shown, margins were generally above what near-term volatility and implied volatility would suggest. So in crude, we definitely saw an increase in margins, but this is to be expected when you layer an oil price war on top of a global pandemic. And for the other products, we actually saw the front-month margin decrease, but again, this was largely due to seasonality. So in general, IM for the major products performed adequately, and we'd like to open it up to any questions. Thank you.
Hi, this is Abigail. Are there any questions from the associate members?
This is Sean Coda from Nephi. Will we be getting a copy of these slide decks, or is
Yes,
that
all of
not
the
possible?
The slide decks will be posted to the EMAC public website, and I can send a copy to all of the members, associate members, and guest panelists participating today.
Thank you so much.
Abigail, any other questions from associate members?
I'm not seeing any from associate members.
If there are none from associate members, let's move on to EMAC members. Are there any questions from EMAC members?
Yes, we have a question from Dimitri Carusos at Nodal Exchange.
Okay, Dimitri.
Hi, everyone. Good afternoon. Hi, JP. Hi, Saeed. Good to see you. I noted that the analysis in the presentation focused on natural gas and crude oil. Just wondering if you had also had a chance to look at power markets. I know from my perspective that they were not under nearly any kind of the same stress that, of course, crude went through this spring, but just wanted to ask if you had also looked at that as well.
Yeah, we do actively monitor electrical markets, and as you said, there just wasn't the same level of stress in those markets that we saw in crude in particular. The energy markets are fascinating in that way, where even though you have highly related products, they're just really idiosyncratic. So it's something that we keep an eye on, and is further being kind of included in that daily systematic surveillance. And it was, interesting this year, but the other products kind of really stole the show as far as concern.
Thank you. Any other questions from EMAC members?
I'm not seeing any questions from the other EMAC members. We do have a question from Commissioner Berkovitz.
Go ahead, Commissioner.
Thank you. Thank you, JP. Thank you, Saeed. Could you explain to what extent the breaches, is it the breach? Is it the volatility of that day? And when the volatility changes or when there's a breach, just the process in terms of what is incumbent upon the exchange at that point with respect to margin? Is there a automatic requirement? Is it discretionary? And then also, what is, if you could maybe explain for the audience and us what our role, what you do at the CFTC, what we're doing real time in this time period, and our involvement at that time. Are we, in terms of your surveillance, are you just watching? Are you interacting with the exchanges, and in terms of how we're following this and what our role is? If you could explain both the regulatory requirement with respect to margin and what the exchange must do, how much discretion they have, and then our actual surveillance and what our role in that is. I think that would be helpful.
All right, so I can take the kind of first part of that question. I'll pass the broader part to Saeed. So when a margin model breaches, there's kind of an immediate notification, and then we kind of look at how that breach corresponds in history. And it's important that we're looking at the margin model from a holistic standpoint. So a breach in a particular product or a particular risk factor is not cause for concern in and of itself, especially since accounts, which is where the regulation really kind of hits home, rarely see the number of breaches that a particular product may experience, and that's largely due to diversification in that margin from multiple products, even though they are slightly offsetting, is typically much higher than the risk that a single product faces. So when that happens, we take a detailed look at the margin breach and how it kind of filters up to the account level. and try again to take a very holistic view to whether this breach indicates a problem with the model's covering of a peculiar type of portfolio or a particular risk factor. But there's a lot of discretion and expertise that goes into risk management. So it's not something that there is a bright line for action. Now, from the broader perspective, I'll pass it on to Saeed for what RSB does. I think you need to unmute.
Sorry, here I'm talking. So thank you, Commissioner, for the question. So the margin models are very model-driven, and increasingly, there is less and less of human intervention in those models. And from our perspective, we actually have built a whole suite of tools where intraday we are tracking activity in the market. So, we don't need to wait to hear from the clearinghouse that a breach has occurred. We get real-time alerts that we have built where we can sort of see these things building up. And we have sort of a mix of different tools at our disposal. And once again, as JP was saying, we sort of take a very a risk-based approach to it. We might be on the phone with the clearinghouse during the day, inquiring about what is happening. During March and April, during all the interesting days that JP was highlighting, we were on the phone with the clearinghouses, understanding how they were managing things. We have account-level information we receive from clearing firms and from the CCPs. So we have watch lists where we're tracking vulnerable accounts. We speak to the CCPs, we speak to the clearing members because the clearing members, once again, are much more closer to the clients. And where need be, we can also sort of go and speak to the clients. So our first port of call typically is to the clearinghouse, and then we sort of speak to the clearing members. And in some of these things, we work very closely with our colleagues in the Division of Clearing and Risk, so that there's sort of a joint approach to monitoring the markets. I don't know if that's helpful, and I can sort of elaborate some more on what we do.
No, that's very helpful, Saeed. And I would just say that to our to the people who are tuned in and watching, the members and associate members and the public, we during this whole period, we were getting, the commission was getting daily briefings by our staff on these market developments, and we were I was pretty impressed with our real-time capabilities. And Saeed, we had discussions during this period about what was going on, and it was really seeing the plumbing in action firsthand during a period of extreme volatility really gave me a lot of confidence that our systems have really been upgraded, and that we have this capability. And I just want to make sure that to give the public some understanding and appreciation of the capabilities and the monitoring that we have. And what we saw today was retrospective as to what's happened over the past 6 months, but we've been compiling that picture and staying on top of it throughout the period, and the dialogue with the clearinghouses the whole time. So I think it's very, very helpful, and I appreciate the presentation where we could take the 6-month look back and see it in perspective, but we actually had the view of this day by day, which was helpful. So thank you, appreciate that, and all the work you've done in your team, you and JP and the whole team during this period. It's been a pretty intense time.
Abigail, do any other commissioners have questions or comments?
I am not seeing any at this time.
Okay. So with that, we thank everyone for participating. Thanks to all the members, the associate members, and the guest panelists for the thoughtful participation and thoughtful comments today. We look forward to the ongoing work of the EMAC and our next meeting on a date still to be determined in spring of 2021. And I will turn it over to Abigail for closing remarks. Abigail?
Thank you. Thank you to all. Thank you, Dina. I now recognize Commissioner Benham to give his closing remarks.
Thanks, Abigail. Just want to thank the committee again. This great presentation, especially this afternoon, was very insightful. And thank you, Abigail and Dina, for your organization, the members for your participation. As we always say, these advisory committees are absolutely critical for us, and especially with all that's going on in the world. In all markets, has become so much more valuable. And again, thanks to Commissioner Berkovitz for his leadership, for bringing these issues to the floor and having a really healthy discussion so that we can continue to think about them together. Hope everyone's doing well, and thanks again, and look forward to future meetings.
Thank you, Commissioner Berkovitz. I now can recognize Commissioner Berkovitz to provide his closing remarks.
Okay, thank you, Abigail. I just again want to thank all the panelists today. This has been a really interesting and important meeting on a topic that's very timely. As Commissioner Benham said, it's just every one of these meetings that we have just reinforced my belief in the value of these meetings. The importance. It's always important. I wish we could do it in person, as I said earlier, but the fact that we can't do it in person, and now we have the televideo capability, which is great. But the importance of just the dialogue and keeping the commission informed. We've been doing a lot of rulemakings this year, and just talking with CIE, we have our daily surveillance activities. So we tend to get focused on the near term, and it's really important for us to broaden our perspectives and look at what's going on in the market generally, and some of the issues that we don't necessarily focus on when we're doing a particular rulemaking. So taking the step back, talking to market participants, being informed on what the current initiatives are, and also where the market might be going, new products. This is our second. This is our second meeting where we've talked about new products. We focused on environmental products last year. Just really important for us. So I just want to thank all the committee members. The success of the committee depends on the members and associate members. It can't be successful without your participation, your voluntary contributions. Everything that you do on this committee is voluntary, and we're all busy. We've all got we're even busier during the pandemic. So for folks who have taken the time and given the presentations and participated in the meeting, I really want to express my appreciation, because it's really voluntary efforts on your behalf that help us be successful. And I'm really proud of our committee and the members and all the advisory committees. This is a great tradition we have at the CFTC, and we're talking about diversity and inclusion. One of the great traditions we have at the CFTC is these advisory committees, which are sponsored by individual commissioners. So we have more than 5 advisory committees, I think. We have 5 commissioners, including the chairman, can sponsor advisory committees. And so the diversity that those viewpoints and the diversity that committees bring really helps strengthen the commission overall. So thank you all again. It's an important topic. Look forward to the continuing discussions on equity, diversity, and inclusion. Significant progress is being made. Significant progress will be needed in the future. It's something that's we will need to keep a focus on going forward, and I'm glad to see that such important strides have been made, and it's really interesting to hear about that today. Of course, I want to thank our chair of the committee, Dina, for your continued efforts into making these meetings successful, and of course, Abigail, our designated federal official, who really again, I have to tell the committee that Abigail's duties as designated federal officer are also all voluntary, not part of her technical job description. So this is above and beyond what she does in the Division of Clearing and Risk, and we're all grateful for that. There's a tremendous amount of work, as you know, in terms of organizing, getting the dates, getting the paperwork, getting the new members on, and that was all done in a timely fashion. Those require commission approval and Federal Register notices and all that. And so we owe a great debt of gratitude to Abigail for all that work. And Lucy Hines in my office too. I want to thank Lucy for all the work she does in working with Abigail and supporting me and helping my office work with all the other commission offices and the committee in making these meetings successful. So again, thanks to everybody, and I look forward to our activities next year.
Thank you, Commissioner Berkowitz. As an amendment to the roll call earlier in the meeting, I am stating for the record that EMAC members Lipa Parikh and Jackie Roberts, as well as associate members Matt Egan, Susan Burgles, Delia Patterson, and Dr. Richard Sandor have confirmed separately they are in attendance for this meeting. Thank you to all the EMAC members, associate members, and guest panelists for your participation at today's meeting. Please stay well and keep an eye out for a survey for dates for the next EMAC meeting in 2021. This meeting is now adjourned. Thank you.